Hi, everyone. Good day to you all. Good afternoon, good morning, good evening, for wherever you're joining us from. My name is Tunmise Olaoluwa, and I am a Forex trader with 7 years experience trading in the Forex and the Forex market. And today I will be joining a few of my colleagues who will be introducing themselves in training you in how to be profitable in the Forex market. Yeah, over to you, Ambrose.
Hi everyone, my name is Ambrose Ebuka. I'm a Forex trader and analyst, and I'm excited about this training as well because I get to share my strategies alongside Tunmise and Happiness, who are also skilled traders in this field. So what I'm going to tell you guys to do is sit back and get ready to embark on this exciting journey of the Forex market.
Okay, guys. Hello. Hope you can hear me. It's Happiness Hanson here. You're all welcome to today's section. Hope you're ready for us because we are ready for you. Okay, so guys, what you're going to be getting from me today, you're going to get to know my strategy and how you can navigate the market. So stay tuned and enjoy the section, guys.
A very interesting conversation around an interesting topic you would like to know about. So let's go. All right. So today we'll be starting with this session called Economic Indicators, a deep dive to macroeconomic factors. And I remain Tunmise Olaoluwa. All right. A quick disclaimer, and please pay attention to this. Any opinion, news research, price and analysis, or information discussed in this training or any linked to this presentation should be taken as a general market commentary and do not constitute an investment advice. All right. That being said, we have a special package for you that comes in form of a promotional code, which gets you 100% deposit bonus. All right. And here are just 5 things you need to do. Number one, you log in to your profile in the Octa trading app or on our website. Also, two, you find the promo code section in the side menu. And 3, you enter the promo code and tap activate. 4, initiate a new deposit and claim 100% bonus in your checkbook. And lastly, complete the deposit process and trade with a booster. All right. So I believe a lot of us will jump in on this opportunity. Great. Now, on to the next. Number first thing we want to look at is macroeconomic indicators and the economy. One interesting thing that we need to understand is that there are factors and indicators that move the economy, okay? And these indicators also give signal, all right, to the health status of the economy. So looking at certain indicators, you get to know if the economy is a strong economy or the economy is a weak economy. And then you also get to leverage on the advantage of 2 different economies when one is strong and when one is weak. All right. So here we are looking at what indicators makes up a strong economy. Okay. Yeah, what indicators make up a strong economy? So we are looking at one, when the current account deficit is low. When the current account deficit is low, meaning that the country has low debt. The country is not indebted to another country, or, in a way whereby it's so large and, they are finding it difficult to pay. All right. And another indication of a strong economy is low inflation. And of course, we know some of us might know what inflation means. Inflation has to do with a consistent increase in price of goods and services. So which means that $100 yesterday, the purchasing power of $100 as at yesterday or last year, is not the same as at today. Meaning, what $100 could buy last year, it won't be able to buy this year. All right. That has shown that inflation has caught up with such a currency. So, but when inflation rate is lower, all right, it shows a strong economy. Then when interest rate is also low. Now, of course, when interest rate is high, it passes a signal to investors. So when interest rate is high, there would be more investment into the economy. People would want to save more. People would want to invest more, meaning that there will be more money in reserve in the economy. When interest rate is low, okay, then there would be more spending. All right, because people will not want to stack up money in the bank without spending it. Okay, so when interest rate is low, it encourages spending, and when people spend, it increases the circulation of money in the economy. So that increases the health, the economic health of the country. All right. Now, let's look at industrial production. When the industrial production of an economy is high, it only indicates one thing. It indicates that the economy has more exports than it imports. All right. Now, when you see a country who struggles with inflation, or who struggles to balance their inflation or to regulate their inflation, look at that country very well. That country is a consumer nation. All right. A nation that doesn't have so much to produce. All right. But when you look at an economy with industrial production, maybe you look at some countries that they're into manufacturing. Okay. Some countries are very strong at automobile. So which means that they would be exporting that automobile for what? For cash. So if I am in Nigeria and I produce, I mean, let's say I'm into farming, all right, and I process my cassava into maybe gari and some other things, and I export it to other country. What happens? I'm exchanging the product for cash. Okay, so the person buying the product for me pays me in foreign currency, of which I will now exchange to Naira. All right. By so doing, I am adding value to my economy, because definitely when I earn money into the economy, I get to spend that money within the economy. All right. And this helps the economy to be strong. Okay. These are very core, factors that shows the strength of an economy or a weak economy. So when an economy is exporting more than it imports, that economy will be very strong. All right. Now let's look at GDP. GDP here means gross domestic product. And when we talk about gross domestic product, is looking at the total production of goods and services in a country within a year. So when a country's GDP is high, it shows that production, trade, and exchange is going on the increase. So when a country's economy, when a country's GDP is high, it signals that the economy is getting strong. So when you look at GDP, and maybe you follow Forex Factory and you Octa FX economic market calendar, and you see that let's say the US news on GDP would be released. All right. And when the news is being released, the GDP is higher than the forecast. It shows that what? The economy has shown a positive signal in terms of its GDP. Now let's talk about the Forex reserve. Okay. So the Forex reserve is the money that a nation has, as you know, as a nation set aside, okay, as reserve, you know, to help strengthen their economy. So the more money that is in the reserve, the healthier the economy. Okay, the more inflows coming into the reserve, the healthier the economy. When the reserve begins to decrease, now it passes a signal that the economy is getting weak. So when you see it, when you look at a country's, you know, foreign reserve chart, all right, and you see that their foreign reserve chart keeps decreasing, it's only signaling one thing, that the economy is getting weaker, all right, and they don't have enough money, you know, to really carry themselves along on a sustainable period of time. So when the foreign reserve is low, okay, what do you think the country will do? What do you think that economy will do? That economy will then, let me get my pen. I want to navigate something. All right. Okay. Good. Now, when the Forex reserve is low, what do you think that economy will do? That economy would now start borrowing, okay, to keep itself running. When the economy now starts, when the country now starts borrowing to keep itself running, what would happen to the current account deficit? The current account deficit will then increase. So when reserve is falling, okay, current account deficit would be increasing. So the current account deficit is inversely related to the Forex reserve. Okay, so both when the Forex reserve increases, there would be no need to borrow. All right, when the Forex reserve increases, there will be no need to borrow, because now there is more money in the economy to manage the affairs of the economy. All right, now let's talk about employment. Okay, let's have this erased. Okay, awesome. Let's talk about employment. All right, when employment is increasing, what does that indicate? That indicates that the economy is healthy. All right, there are more jobs. Okay, so in a situation whereby there are more persons with jobs than there are with no jobs in an economy, is a great signal. Okay, but and when the number of unemployed for last month, okay, becomes lower, all right, than the unemployment rate of this month, it only passes an indication that if this month's unemployment rate has increased and it is higher than the last unemployment rate, it's only signaling that there is no money in the economy. Because if you observe the global economy, when money is flowing into the economy, more jobs will be created. All right, more persons will be hired, will be employed, will be gainfully employed. And by so doing, when people are gainfully employed, what happens? They are placed on a payroll. And when they are placed on a payroll, they get paid their salary monthly. At the end of the month, okay, at the end of the month, when they are paid their salary, says someone is paid, you know, $5,000 as salary. And the person takes this $5,000, takes $1,000, pays for the electricity bill and some other bills in the house, takes $2,000, pays for the house rent. The electricity bill goes to whoever, you know, provided the electricity. The rent goes to the landlord. The landlord has children, all right, has children that he needs to provide for. Then the landlord goes to the grocery store, buys some food. Then the landlord gives the seller in the grocery store the money, okay, in exchange for the groceries. And by so doing, we can see that what money begins to flow within the economy. All right. So when unemployment is high, it only signals that there is no money in the economy, because it's only when there is money you will begin to hire more persons. All right. So that is it about employment. So when employment is rising, okay, there is the economy is strong. When employment rate is falling, then the economy is getting weak. So these are major indicators that will tell you the direction of a country's currency. Now let's look at savings and purchasing power. All right. Now, if you get paid $1,000, all right, or you picked $1,000 from your savings, and last year you could buy something, when they are weighed together, they are, say, 10 kg, which means what you spend $100 to buy was a lot, all right, and up to 10 kg when they weighed the entire goods, all right. And this year now, you take the same $100 to the market to buy stuffs, to buy goods, and only for you to buy the goods, and when they are being weighed, it's not even up to, it's not even up to 5 kg. Or so what your purchasing power means is the capacity, or how many goods can your money, which is $100, buy. Now, when the purchasing power of your currency, of that $100, keeps dropping, which means what the $100 could buy last year, it could not buy again. It is bad for the economy. So when purchasing power is increasing, it's good for the economy, which means that your $100 is worth more than it used to be last year. But the moment your $100 is worth less, okay, than it used to be last year, then there is a problem. That is not good for the economy. So these are factors that indicate if an economy is strong or an economy is weak. Now, lastly, investment. Okay. Now, when people are being paid well in their employment, all right, what happens? It is when you have money, you are going to remember that there are stocks to buy. Okay. It's when you have money, you are going to remember that there are some investment and some of your assets, some assets you need to acquire. Okay. If you are not earning as much, you won't be thinking of acquiring any asset or even investing. Okay. So, but the more you earn, the more you invest. Can you see that these economic factors are so much interrelated and some are mutually dependent and some are mutually exclusive? All right. So you look at unemployment rate now has a direct impact on investment. Now, how many of you remember the time of COVID in 2020 when COVID broke out globally? What happened? The government provided palliatives, okay, to cushion the economy. The US, the citizens were given some amount of money. Now, a lot of persons had free money coming into their hands without actually having a need per se. Okay. Now, when this free money came into their hand, what did they begin to think of? Oh, let me put it into stocks. Oh, let me put it into Forex. Oh, let me put it into varieties of assets, because there were more money in the economy chasing fewer commodities. So you remember that in the COVID period, there was a slowdown in production. but an higher amount of money in circulation. Now, what that higher amount of money in circulation in the hand of the individuals went to was majorly investments. Okay, so this only signals one thing. When there is more money in the economy, a lot of persons will want to invest. So these are major indicators, all right, that drives growth in the economy. All right, great. I believe that you are following so keenly. At the end of this workshop, I have some quiz questions for you. All right, and this quiz question there would be prize for the winner. Okay, the first person to drop the correct answer, okay, at once, to drop the correct answer at once, would get the prize. All right, so follow very keenly. This is more like not just an economics session, however, a thorough training into what actually drives the global financial market. So yeah, let's look at an introduction into economic indicators are vital statistics that provide insight into the health of the economy. Okay, now a strong industrial production, a high employment rate, a high savings and purchasing power, a high investments, a low interest rate, a low inflation, a low current account deposit, a high Forex reserve, and a high GDP. All right, great. Now, let me take off my pen. Okay, so economic indicators. Now, these indicators can be categorized into three main types. All right, these indicators can be categorized into three main types. Number one, we have the leading indicator. Number two, we have the lagging indicator. Number three, we have the coincidence indicators. All right. Now, when we talk about the lagging indicator, the leading indicators, which is our number one metrics here, it's a metric used as a predictive measure of future performance. Okay, it's a metric used as a predictive measure of future performance. So leading indicators are looking at the future occurrence. Okay, the future occurrence. They are not taking into consideration the present, they are taking into consideration the future. So they are predictive measures of future performance. Okay, now lagging indicators. Lagging indicators are metrics used to measure past performance. All right, so when you see lagging indicators, they are looking at what has happened in the past, historical data. All right, so lagging indicators use historical data, okay, for its performance. It's used in measuring past performance, while leading indicators look at future performance. So we have here past performance for lagging indicators, future performance for leading indicators. All right, now coincidence indicators happens when both leading and lagging indicators are happening at the same time. Okay, that's coincidence indicator. Now, coincidence indicator are examples like the non-farm payroll. Okay, now let's look at lagging indicators. Now, lagging indicators, we say measures goals accomplished, is easy to measure and hard to influence. all right? It's hard to influence past data, past information, okay? It's hard to influence. It is also easy to measure because you already have the data, the historical data from the past, okay? You already have the numbers and the market and price movements, the touch points of price from the historical data, okay? So it's easy to measure. It's hard to influence. You cannot change the level at which you can't go back to Euro USD data now and say you want to change last month's price movement. It's not possible. It has occurred already. All right. Now, but for leading indicator, it predicts goal, okay, and achievement. It is difficult to measure, all right, and easier to influence. So definitely you are looking at future performance, okay, and you begin to predict what would most likely happen, factoring into the forecasted rates of maybe unemployment rate, GDP, and amongst others. Now, let's look at GDP as the cornerstone of an economic health. Now, GDP happens to be known as gross domestic product, okay? Gross domestic product, in this sense, it is the total monetary or market value of all the finished goods and services produced within a country's borders in a specific period, okay? Now, GDP, looks into the total monetary activity, the total monetary values of all finished goods and services produced within a country's border in a specific period. So GDP factors into production, factors into sales, factors into services, factors into manufacturing. Every activity that that generates monetary value, okay, are factored into GDP, okay? And this must be activities that happen within the country, not outside the country, within the country in a specific period. Now, what are those things that makes up GDP? All right. Now, we look at consumption, all right, when factoring GDP. We look at government spending when calculating GDP. We look at investment when calculating GDP. We look at net export expenditures when measuring GDP. Now, GDP has three approaches, okay? GDP has three approaches. Number one, we have the expenditure approach, the income approach, and the production approach, okay? Now, when we talk about the expenditure approach looks into consumption, adds it up to investment, adds it up to government, and adds it up to net export. And you know how we got this net export? Net export is export minus import, okay? Export minus import. So that's how we get this net export. But when you now add net export to government expenditure, to investment, and to consumption, it will give us GDP using the expenditure approach. All right? Now, when we use the income approach here, we are factoring into strictly all revenues and income generated. And these incomes comes from wages, added to rental rates on capital, added to firms' profit. So when we sum that up, it will give us GDP using the income method. Now, lastly, we have the production method, which looks into the final value of all goods and services minus the intermediate cost, okay? Intermediate cost. So that would give us GDP using the production method. Now, GDP growth rate tells us a lot about an economic health. So here we'll be looking at interest rates. Okay. Now, interest rate here is talking about the interest rate directly influences the strength of a currency. So the central bank's interest rate decision, higher interest rate attracts foreign capital. Okay. When there are higher interest rates, it attracts foreign capital because more persons want to invest in the economy because what the interest rate is higher. Okay. With higher interest rate, it decreases the urge to spend and increases the urge to invest. Okay. Now, interest rate differentials. Differences in a country's interest rate influences the currency value. So when you look at the currency, the interest rate of two different currencies, all right? When you look at the interest rate of two different countries, okay, and you notice a differential, okay, in their rates, which means for, let's say, country A has 2.8 interest rate and country B has 0.6 interest rate. Now, this can influence investors' decision as to either investing in country A or investing in country B. But from the reality now, when interest rate is high, okay, it influences investors' decision. Okay, so it attracts in foreign capital. It increases investment. So people would want to invest in a country with a higher interest rate than a country with a lower interest rate. Okay, and here are how interest rates are charged. Some of you might be looking at it. Okay, how are interest rates charged? Okay, what is how does it go? So yeah, interest rate, a rate is charged for borrowing money. Okay, now rates are charged on loans by banks, okay, to their principal, okay, and the principal pays back and the borrower pays back the principal with interest. Okay, now that interest is based on what? The interest rates charged. Okay, now how are interest rates determined? Interest rates are determined from Fed policies, borrower economy, borrower credit score, loans length, secured and unsecured loans, okay, are used to influence and to determine interest rates. Okay, great. At the end of this session, I will be asking very important questions, which will serve as a quiz, and there will be prize given. So please do well to pay rapt attention. Now, inflation rate. When we talk about inflation rate, it is also called, consumer price index and producer price index. So inflation rate is viewed from two bird eye view, from the eye view of the consumer and from the eye view of the producer. So let's come from the eye view of the consumer. So the consumer here, the consumer interest rate here are called consumer price index. Now, what does this mean? This means that this is the average price change consumers pay for goods over a period of time. Okay, now higher inflation reduces the purchasing power, slowing down growth. So now what this consumer price index looks into is the average price that changed, okay, over a period of time. So let's say what can I use as an example? Okay, here is my wallet. Can you see it? Here is my wallet. Okay, I bought this wallet for $100. I'm giving an example now, yeah? I bought this wallet for $100 last year. All right. Okay, I then go back to the market. Okay, I go back to the store to get this wallet this year, and I discover that this wallet is now worth, you know, $1,005. All right, $1,005. So there is already a difference between the price of this wallet last year and the price of this wallet this year. Now we now CPI now factors in the average price change. So the change between the change in price between last year and this year is what CPI would factor in, the average price change. All right. So, and when inflation is high, okay, it slows down, it reduces purchasing power and slows down growth. Okay, good. Now, producer price index. Okay, now producer price index tracks how much producers are getting paid for their goods over time. A higher PPI leads to an appreciation of the currency. All right, good. So producer price index is factoring into how much a producer is getting paid for their goods over time. So this is actually making sense now, because the producer price index is looking at when a producer produces a particular goods and sells it, how much is that goods worth, okay, over time. Now, the worth of that goods over time would determine the PPI. And when the PPI is increasing, it shows that what the value of the currency is increasing. But when CPI is increasing, it shows that the purchasing power is reducing and growth is slowing down. Okay, good. Now, when we look at PPI versus CPI, PPI looks at domestically produced consumer goods, which is wholesales. CPI looks into domestically produced consumer goods at retail level. Then PPI factored into capital equipment, while CPI looks into imported consumer goods. Then CPI looks into services as well. Now, unemployment rate. The higher unemployment rate typically indicates economic weakness. So when there is higher rate of unemployment in a country, it shows that the economy is weak. There would only be higher rate of unemployment in a country when there is no money in the economy. All right, when the circulation of money in the economy is slowing down, because like I said previously, when there is money in the economy, people would want to create more business, people would want to employ more people, you know, and then they get to be paid. Okay, and when they are paid, those paid will get to spend on one services or goods or the other. Now, for unemployment now, this can lead to a decrease in consumer spending. Okay, this can lead to a decrease in consumer spending, lower inflation, and potentially prompt central bank to lower interest rates. This environment often results in a weaker currency value. So when there is higher unemployment rate, it leads to decrease in spending, because of course, it's when you have money you get to spend. And also, by so doing, it lowers inflation rate and potentially prompts the central bank to lower interest rates. And you know what that means? When the central bank lowers interest rate, it discourages investment, discourages foreign inflow of currency. Okay? And when it discourages foreign inflow of currency, what happens? It weakens the economy's currency value. All right? It weakens the economy's currency value. So this is how unemployment rate is being calculated. Unemployed divided by civil labor force. Okay? So the total number of civil labor force, the total number of unemployed divided by the total number of civil labor force. Okay? And then we get unemployment rate. Okay? Good. So, balance of trade. This is one interesting indicator that you should pay attention to. Now, balance of trade has two categories, okay? We have the trade surplus and the trade deficit. Now, how do we get trade surplus? How do we get trade deficit? When a country, okay, exports more than it imports, then there would be a trade deficit. A trade deficit in the sense that there would be more money coming into the economy than there is going out. Okay? Now, trade deficit happens when there is more imports, which means the people of a particular economy depend so much on foreign products. Now, when that happens, there is more money leaving the economy than there is coming into the economy. All right? And this is a very important factor. So when export is greater than import, there will be surplus because more money is coming to the economy. And when import is greater than export, that is deficit because there is less money coming into the economy and there is more money going out of the economy. So when you see a country who has more deficits and less exports, you definitely know that it is heading for, it is becoming a weak economy. So guys, thank you for joining. Right now, we will be having a short break and we'll be right back. Thank you guys. Stay with us. All right. Welcome back. Welcome back. So quickly, we go straight to the quiz time. Okay, the quiz time. So the first person that drops the right answer would get a prize. All right. So are we ready? Are we ready? I'm going to count 5 and I would show the first question. 1, 2, 3, 4, 5. Question 1, read it. Explain the significance of unemployment rate as an economic indicator. What's your answer? A, B, C. You pick one. You have 10 seconds. You have 10 seconds. Okay? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. The next question. What do retail sales figures signify about an economy? You have 10 seconds. 1, 2. If you are answering question 2, just write Q2, then your answer. Q2, then your answer. Question 2, I'm counting 10 seconds. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right, thank you. Question 3. What is the consumer price index and how does it affect purchasing power? You have 10 seconds to answer this question. So when you want to answer this third question, do Q3, then your answer. Q3, then your answer. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. Then lastly now, we have question 4. Name the 3 main types of economic indicator. When you want to answer this question, just do Q4, then your answer. Q4, then your answer. I'm counting 10 seconds. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Awesome. Awesome. So that would be the end of the quiz session. All right. That would be the end of the quiz session. Anybody that drops an answer after now won't be considered. Okay. So we have the answers already prepared. So we move to the question and answer session. So quickly, let's look at the answers. Okay. For number 1, A. Number 2 is B. Number 3 is C. And number 4 is D. So for number 4, we have A as the correct answer. Then for number 2, for number 3, we have C as the correct answer. So the consumer price index reflects the fluctuation in the stock market price and has no direct impact on purchasing power. Then number 2 is B. Okay, high retail sales figures indicate strong consumer confidence and spending, which can stimulate economic growth. Then number 1 is A. Okay, so now we move to questions and answer. Okay, questions and answer. Questions and answer. If you have any question, please do well to leave it in the comment section. Okay, if you have any question, please do well to leave it in the comment section. If you have any question, do well to leave it in the comment section. Okay, I will just give us 1 minute to write out our question and I would attend to it. All right. Which is the first question here? Okay, we have a question here. It says, is there a downside to high employment rates and increased spending power on the economy? Okay, is there a downside? No. There is no downside. So for high employment rates and increased spending power is good for the economy. Okay, it shows the economy is strong. Okay, and shows the economy is healthy. All right. Okay, I'm waiting for the next question. Okay. All right, someone is asking core CPI and CPI. Okay, so for core CPI now, core CPI excludes food and prices, okay, from CPI. So it factors in every other factors and excludes food and energy prices. So that's what gives the core CPI. All right, good. Okay, what other questions do we have? You're welcome. You're welcome. Yes, there's a lot of difference between foreign reserve and interest rate. So when we talk about foreign reserve, we said that foreign reserve is the money that the government set aside, okay, or the nation sets aside, all right, to help cushion the economy. Okay, so when the foreign reserve is high, okay, it is healthy for the economy because there will be less borrowing, okay, because now there is more money within the economy. All right, but when the foreign reserve is low, it is bad for the economy. All right, and the foreign reserve is different from the interest rates, okay, because interest rates are like they are one of the indicators that the government use, so, or the central bank use to control monetary policy. All right, so you increase interest rates when you want to increase foreign inflow of capital, or you want to increase investment. And also you reduce interest rates when you want to encourage spending and discourage investing. So just so that people get to spend more than they keep their money. Okay, so that's the difference between interest rate and foreign reserve. What other questions do we have here? Okay, as trader, if two indicators are pointing to a positive direction, then one other indicator is pointing in another direction. I seem not to get the question, but you can always rephrase your question. Okay, you can always rephrase your question. All right. Don't forget that we have a promo package for you where you get 100% of your deposits once you open an account. There are 5 things to do to access this deposit promo. Number one, you log into your Octa trading app or our website. Find the promo code section in the side menu, then enter the promo code and tap activate. Okay, when you do that, initiate a new deposit and claim your 100% bonus in the check box. Lastly, you complete the deposit process and trade with a booster. Okay. All right. So Yeah, the winner of the quiz would be announced, right? They would reach out to the winner of the quiz. Okay, thank you very much for joining. Right about now, we would be getting into the live trading section. Okay, we're getting into the live trading section. So right about now, we'll be going into the live trading section. Taking off with Euro USD. Okay. All right. So here we have Euro USD. Interestingly, I would like to start with the top-down approach. Okay. The top-down approach coming from the monthly time frame. Okay. Okay, good. Good, 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 good. So on the monthly time frame, number one, we are asking ourselves, what is the overall market structure? Okay, what is the overall market structure? And this is very, very important to us. Because right here now, the overall market structure so the overall market structure here is downward movement. Okay, so here we can see that Euro USD has been downward sloping. Okay, and so here we are trying to map out levels of support and resistance. Those are key levels, support and resistance. Okay. So checking out key levels of support and resistance on the monthly time frame. Okay. So now let's go down to the weekly time frame. Over here on the weekly time frame, we would also look at some of the support and resistance on the most recent price movement. So here we'd see, okay, we already have something here. So the next resistance zone would be at this level. Okay. So right here, would look into this chart and we can see that there are minor support zones, okay, of which we could identify here, minor support zones. We saw how price picked up from this level, and same thing happened here, okay? So this level is like a key level to also watch. So let's go down to the daily time frame. So on the daily time frame here now, it's obvious to us that price has been ranging at these levels. Let's identify these levels out here. Okay. And when we look at it from the weekly time frame, we'll definitely see some buy momentum coming in. We'll definitely see some buy momentum coming in from the last 3 to 4 candles. So these candlesticks are also a good way to monitor price movement. So we can see that on this support zone, there is you know, let's say this looks like, this is more like a bullish pin bar, okay? And price has pushed up twice. You can see a bullish pin bar here. Here looks like a doji. And when you see these candlesticks on a support zone, it's also a good way to have, you know, more confluence. So when you look at this level here, we saw that price is coming to a support zone, okay? However, not only a support zone, the weekly time frame on this level also ended in a doji, right? So when you see a doji on a support zone, okay, it gives a higher probability of market reversal to the opposite direction, okay? So when you see a doji on a support zone, then market is bound to, you know, to move upward, okay, in reversal to its previous direction. And that is what we can also see happening at this level, where we spotted both a doji and a bullish pin bar. All right. Now we saw how price actually reacted in the week that followed, and we saw the bullish momentum came in at this level. All right. Now, what is going to happen at this level here is, once price crosses this zone, okay, this is a minor support and resistance zone here, all right, which is happening this week. So let's look at it on a line chart. Now, when you look at it on a line chart now, you can definitely see that there is a minor support and resistance zone at this level. A minor support and resistance zone at that level. And that minor support zone and resistance level cannot be ignored. Okay? So we need to pay attention to it as well. Now we see that price is currently sitting pretty on that zone. Okay. Now what we'll be looking at on this weekly time frame is price closing outside this minor support zone. Okay. If price close outside this minor support zone, then we would see Euro USD coming to touch this level, this next support level, or this next support level. All right, that is what we would see Euro USD most likely do. All right. Now, when we go down to the daily time frame, good. Now we have a clearer picture from the daily time frame. So look at yesterday's candlestick. You know, what did you spot on yesterday's candlestick? Here is a doji. Okay. Now at this level now, we can see that price is consolidating at the level that we mapped out as a minor support resistance zone. Okay. This level where we mapped out as a minor support resistance zone is now the zone that, you know, we can see that price is consolidating. Okay. So if you look at the historical price movement from this end, okay, when price has sustained certain movement and gets to a support zone or a resistance zone, it doesn't just cross it all at once. It doesn't happen like that. Okay, that momentum where price gets to a resistance zone and just push up without having to rest a bit is quite unusual in the market. But when you look at historical price movement, you definitely see that when there is a sustained momentum, when price gets to the next resistance zone, there is always a consolidation, one or two candles consolidating at that level before advancing upward. Now, we can see the same happen here when price consolidated a bit here before moving up. Okay. Now, these are, very important, very important levels to watch. Okay, good. So on this chart now, which is the daily time frame. So if you are an intraday trader, you would want to abide by the observation I made earlier. So we would need the price to close outside this resistance zone. Okay, this minor resistance zone. Let me map it out again. We would need price to close outside this zone. So when price closes outside this zone, okay, then there is the bullish momentum has been confirmed. All right. Well, since price has not closed outside this zone, we might see, price resting a bit. Okay. There might be a little drawback, down to this level. Maybe we see price consolidate. Okay, so we see price, either get pushed back and consolidate at this level, takes another momentum up until this level before breaking out of this level. Okay, so however, there are higher chances that price would pull back a bit from this zone. Okay, however, if there's any reason to buy, you want to wait for a confirmation, seeing price break out of this level and closing above this resistance zone. It is there and then you can make a move, to buy at that level. Also. So let's look at it from the 4 hours time frame. Okay, so from the 4 hours time frame, we can see price consolidating at this level as well. If price breaks out of this level and closes outside this minor resistance zone, then the buy is confirmed. Okay. However, if price has not broken out of this, minor resistance zone, you might want to wait to see what price will do next, either a pullback, okay, or a breakout from this level. So for now, you are neutral, okay, about what price would do, and you just want to watch, if price would break out of this level or if price would take a rest backwards, okay? However, the general market outlook on Euro USD here, when you go back to the weekly time frame, okay, is bullish. Okay, is bullish. So if you are a long-term trader, okay, Euro USD is a good buy if you are a long-term trader, because from the higher time frame, we can see the buy momentum coming in. All right. But for intraday traders, okay, you want to wait for confirmation to see Euro USD break out and close outside this level, or to see Euro USD either take a break, between these levels before finally breaking out of it. But if you are a long-term trader and you don't mind holding your trade for a few days, few weeks, you might want to also consider buying now and holding, your trade. Okay, good. So either if you're an intraday trader, you want to wait for confirmation of markets closing outside the minor support zone. If you are a position or a long-term trader, then you want to long Euro USD and sit back to see how it turns out. Okay, so that is it on Euro USD. Okay, let's look at USD JPY. USD JPY. USD JPY. The USD has been gaining strength over the yen, the Japanese yen. Okay, you see how the USD has been gaining strength over the Japanese yen. All right. Now, there is something you need to understand, that the Japanese yen has experienced over 50% rise in inflation, okay, and has lost 50% of its value to the US dollars, okay? Don't forget, when we talk about, interest rate differentials, okay, we can also look into inflation rate differentials of these two currencies. Now, as we speak, the US dollar is far stronger than the Japanese yen, fundamentally, okay? And the fundamentals get to play out in the charts, all right? So we can see that in the overall price movement, USD JPY has been moving upwards. Great. Now, let's map out some levels of support and resistance. That is what looking into, okay? That is what looking into while making our analysis. Here is a support and resistance here. Here is another support and resistance. Okay. here is another resistance zone to watch out for. Okay. When we look at the previous weeks, okay, with the indication of candlesticks, the momentum we got from the price movement of Euro USD last week is enough to cast a doubt on a further push, a further bullish momentum. All right. Now, why is it enough to cast a doubt on the further bullish momentum? Is we can see that the candlestick last week closed far below 5 previous weeks candlestick. So let's count from here. We see 1 week, 1, 2, 3, 4, 5, 6. Now, and we can see the level at which they all closed. Okay. Now look at the level at which last week candle closed. The candle chart for last week, it closed far below it. Okay, far below it. Now, one important thing to note is that for the price closing far below it is also a strong signal of, you know, a bearish momentum. So longing the USD JPY might not be on a long term. Okay, so you want to, if at all you want to long USD JPY, you want to look at it on a short term. All right. So this is the weekly time frame. Let me go backwards to upward to the monthly time frame and see it from the monthly time frame so that we can have a clearer view of, you know, the information, a broader view of the information. So on a broader view now, we see that there is a lot of bullish momentum coming in on USD JPY. Okay, so which means we can see how price, you know, buyers pushed up price up onto this level, and we see how sellers pushed down price a bit. Now, from this chart now, we can see that, you know, the buyers have placed a buy order at this level. Then this level now has become a support level. Okay, a support level that would keep price, you know, from easily breaking downwards further. So let's go back from here. Now we can see that, you know, on a monthly time frame, the price movement, predicting the price movement, what we can see is up and up only. So the higher probability of price movement here is upwards. Okay. Now let's go back to the daily time frame. Okay, good. Now, some interesting thing to observe here. Now, what do we observe at the support level here? What do we observe at the support level here? Who can drop that comment in the chat box? What do we observe at the level here? What do we observe? What do we observe at this level? What do we observe? Who can tell me? What do you observe at this level here? I'm waiting. I'm waiting. I'm waiting. I'm waiting, guys. What do we observe at this candlestick, at this support level? What candlestick is this? What candlestick is this? I'm waiting for the first person to tell me. Okay, I'm waiting. Someone said, okay, the first person said Doji, another person, awesome, awesome. Matilda, and Digital Pilot. Thank you, thank you, thank you. Good, so this is a doji, okay? And what did you see that followed the market, the price next? We can see a bullish momentum already coming in, okay? Now, what do we anticipate on this price movement? What do we anticipate on this price movement? A strong bullish reversal. A strong bullish reversal. So we can, from here now, we're expecting price to move upwards. Okay? To move upwards. All right? To move upwards. Interesting. I love this. So, what am I doing? I am definitely buying USD JPY at this level. Okay? So we can see that from the monthly time frame to the daily time frame, USD JPY is bullish. All right? Good. So we are longing USD JPY. In fact, I have trades running on USD JPY on a buy. All right? So this is an open information to educate you on understanding how to be profitable in the Forex market. So here we see that the USD JPY, the price is, there are higher chances that the price would go up. All right. There are two resistance levels it would meet. And let me do something real quick. Right here, we can see market might consolidate here a bit. Okay, at this level. Then we might experience a breakout. That breakout will lead us up until this level before price consolidates again, reverses down a bit, and continue moving up. All right. So, excuse me. So this might be what we would see on Euro US USD JPY. Okay, great, great. Now let's look at, okay, now so let's go down to the 4 hours time frame. Now, what did we observe on the 4 hours time frame? Here is what I see on the 4 hours time frame. So we can see the market, the price movement forming a curve. All right. Now, from this level here on this curve, we'll see a jump. Okay. On this curve, we would see a jump. So definitely you want to look into this and stay positioned. Okay. Stay positioned. Yeah. All right, let's take a look at GBP USD. Let's start with the monthly time frame. Okay. So here we can see that there is an overall price is on an overall downward movement. Okay. Price is on an overall downward movement here. So now let's map out the market structure that we have here. What are the market structures that we have? Here we have support zone, a resistance zone. In between here, we have a minor support and resistance at those levels. Okay. Now, what are we looking at? What are we anticipating at this level? Let's go to the weekly time frame. But before then, let's observe that price is right at a resistance zone. Okay? Right at a resistance zone on this level. Okay? And, you know, we might just see price pull back. Okay? From here, before coming back to retest and probably breaking out. But before then, let's look at the weekly time frame. The closer the time frame, the broader the view and the clearer the view. So we can see that on the weekly time frame, we can see that price is having a bullish momentum coming from the candlestick perspective. We definitely see here how this candlestick has closed above previous candlesticks. So let's look at candlesticks at this level. So let's count them: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. You know, every candlestick here, this single candlestick has moved up and closed far above every one of them. Now, this is only telling us one thing: the buy momentum, the buy pressure. All right, it's telling us that the buy pressure is coming in, okay, from this level. So we might experience from here a breakout of this zone, or we might experience a quick reversal from this support and from this resistance zone. Let's go down to the daily time frame. Let's go down to the daily time frame. Good. Interesting observations on the daily time frame. So here we can see how price, broke out from these levels, from this particular level. Okay. Good. We can see how price broke out of this particular level, up until this level. All right. And now price has touched the resistance zone, which was immediately the following day we had a sell pressure, at this level. So what might happen for a while at this level is price might consolidate a bit at this level, which might take a week, okay, few days or a week, right? And then we see either a breakout from this level or a pullback, okay, a pullback down to the next support zone, okay, down to the next support zone. So let's go down to the 4 hours time frame. Okay, good. So on the 4 hours time frame now, on the 4 hours time frame, we can see how okay, you can see from here how price reversed at this level, and then a little buy momentum building up at this level. Not sure of a certain the momentum, if this momentum would be stronger, okay. However, I will just look out for confluence at this level. Okay, I will just look out for confluence at this level. And the confluence I would look out for is price breaking out of this zone, this resistance zone, okay, and closing outside this resistance zone. Okay, these are the confluence I would be looking out for. Okay, so if you have any question, I think from what I've explained so far, I would just do a little pointer, and then, we get to the next section of the program. Okay, if you need clarity as to what I've just explained here, please do well to ask in the comment section. If you need clarity, please do well to ask in the comment section. Any clarity? Any clarity? I can see you guys are following. That's great. That's great. That's great. Okay. If you need any clarity, please ask before we go on a break. Right. If you need any clarity on what I've explained, please do well to ask. Okay, so now let's check out the 1 hour time frame. Let's check out the 1 hour time frame. Okay. So from here now, we could still see how price is not giving so much of a signal for a momentum. So you might want to stay a bit clear of GDP USD and wait for, some very clear confluence, to move either to buy or to short the market. What is the difference between the time frame? What is the difference between the time frame? Okay, so the difference between the time frame goes to show you that each candlesticks are formed within, goes to show you that each candlesticks are formed within different time frames. Okay, so we are on the 1 hour time frame now. That shows you that each of these candles are formed within the range of an hour. Okay, an hour, an hour, an hour. So each of these candles are formed in an hour. So when we look at the weekly time frame, or let's say the 4 hours time frame now, it will take it took 4 hours for each of these candlesticks to be formed. Okay, it took 4 hours for each of these candlesticks to be formed. When we look at the daily time frame, okay, it took 1 hour, 1 day, okay, for each of these time frames to be formed. All right, good. So on this daily time frame now, I just realized that the buy momentum had come in and then there had been a reversal. Price is at this level now. Now, once there is a breakout from this zone, okay, from this resistance zone, our market closes above this resistance level, then it's a buy. Okay, then it's a buy. All right, that is an important observation from here. Okay, good. So we go back to this is 2 hours. Let's go back to 1 hour. 1 hour. Do we have questions here? Okay, is that how does the market always have to pull back once it's so the market does not have to pull back once it gets to a resistance or support zone. However, when there is a breakout, okay, when a breakout occurs, there is 80% chances of a pullback. When a breakout occurs, there is 80% chances of a pullback. So look at this breakout here, and then look at the pullback. So the market coming back to retest the support or resistance zone it broke out from. All right. So look at this. When there is a breakout, there are 80% chances of a pullback. So you see the market pull back a bit and then came back to test the resistance turn support zone that it broke out from and then keep going back up. All right. So when there is a breakout, there are 80% chances of a pullback. What if a news counters the direction? Sure. So you don't want to trade, an hour or 30 minutes to a major news. Okay. Except you are actually trading the news. All right. It's important for you to know, your terrain, what terrain you want to play around in. Do you want to play in a terrain where the news is active, or you want to play in a terrain where the market is quiet? There are no news that can actually, major news that can actually move the market. So you want to be sure of that. So the news can come and change the direction of your market. Okay. So that's what I call fundamentals. So you have to look at your economic calendar to see that, okay, the period in which you are trading, is not within the period of the news. If you're a long-term trader, if you're a short-term trader, you have to factor in, news that comes in and out of the day. If you're a long-term trader, that might not be part of what you factor in. You just factor in the general market structure and, the potential price movement. Okay. Someone said, what is the best time frame? I've said that. Okay, there are no best time frame, but there are time frames that are suited for your kind of trading. Okay, if you are a scalper, you are trading within a short period of time, a very short period of time. You are looking at 5 minutes, 30 minutes, 1 minute, 15 minutes time frame. If you're an intraday trader, you are looking at 30 minutes, 1 hour down to daily time frame. Okay. And if you are a position trader, a long-term trader, you're looking at daily time frame to monthly time frame. Okay. Someone said, if we are not trading off monthly time frame, why analyzing it? Why analyzing from it won't it bring I don't get this. I don't get this. So we are using if I get it very clearly, we are using the monthly time frame to get the overall market direction. Okay. And the market direction where price was, in the previous month. Where was price in the previous month on the monthly time frame? That can be a major clue, okay, to how next month would go. All right. Good. Someone says, yeah, I've said that. What if the news counter the direction, blah, blah, blah. Yeah, the news can counter it. So you want to either stay off trading within the period where the news will be released, maybe like an hour to the news or 30 minutes to the news. You want to stop trading. Says, when is it the best time to enter a trade at the breakout point, or when it's the pullback? Okay, so would I say there are no best time to enter a trade, but you want to enter a trade at a point whereby you have a higher chance of riding the wave for a longer period of time. You don't want to buy into a currency that has already gone high enough that when you check the daily time frame and count 12 candlesticks to the left, you would not see any candlestick. So let's use something as an example. Let's check out this. Okay, good. Now look at GBP JPY USD, right? Has moved up until this level. Okay. Now buying it at this level when it is already high doesn't make any sense, because you are definitely shooting yourself on the foot. Now, how do you know that it is not a good time to buy? Is when market has gone so high that on the higher time frame, like daily time frame, when you count 12 candles to the left, you will not see any candles that have gotten to that level before. If you look at this now, you will not see any candle that has gotten to this level before, on the daily time frame. That is a very strong indication that when price gets into that level, it is definitely going to reverse. All right. It's definitely going to pull back. So when you see price gets to a level it has never gotten to before in the past 12 days, okay, or more, then you want to start shorting from that level. So instead of buying, you want to start selling, okay? Because whoever have bought will definitely want to sell at that level, at those levels. So there is no best time to enter a trade. However, you want to enter at a level where you can ride the wave for a long time. So imagine you sell at this level now, you're able to ride down, for the next 48 hours, and then you make your money, you exit, and that's all. Okay, so we'll be having our break very soon. I'll just take one or two questions, one more question. And the question says, okay, thank you, David. Said beautiful, thank you. So what do you think about the live streaming signal on? I don't know about that. Said, okay, there are pretty much no question. Yes, okay. So this one says, when is it best to enter a trade? I've answered that. All right. So we are going straight to having our break now. Thank you for joining this session. We have lots more sessions, very educative, and you don't want to miss out from it. Stay with us. Thank you.
Hello. Hello, everyone. Good afternoon to you all from my time zone. You're welcome to the second phase of this section. You all are welcome. So let me get to know the class of traders I have present. Let me get to know the class of traders I have present for this second phase. Let me get to know the class of traders I have present. Okay, someone is saying in the comment, I can't hear. Please let me get to hear from you guys. Can you hear me? Can you hear me? Hello, can you hear me, guys? Hello, guys, can you hear me so that I can proceed? Can you guys hear me? Okay, wonderful. So once again, you're welcome to the second phase of this section. Hope you are learning a lot already. I was here all through the first phase or the first section from my colleague, Tunmise Olaoluwa, how he was able to break down factors that affect countries' economy. So that was quite an interesting section. Hope you grabbed a lot from that particular section because me, I did. So hope you did too. So you can keep dropping. I can see you all. You're welcome to this section. You can keep dropping. I want to know the class of traders I have present. If you're a beginner, you can just state beginner in the comments. Then if you are, or if you've been trading, you can just state, how long you've been trading in the comments. You can just state how long you've been trading in the comment. So guys, I will be, focusing more on developing on how a trader should develop the right mindset when trading. So it will be around, the trading psychology aspects, your mindset as a trader. That is what we'll be talking about today. We've had the first section, and like I said, it was, more of fundamentals. It was an interesting section. So during my section, which is now, we'll be talking about, or we'll be looking at the trading psychology aspects. We'll be focusing more on how you should, trade with the right mindsets. You're welcome. So guys, a quick disclaimer. Any opinion, news, research, price analysis, and other information discussed in this webinar or linked to this presentation is provided as a general market commentary and do not constitute investment advice. You're welcome once again. All right, guys. So I can see most of you. I think I have more of beginners in this section. I have more of beginner traders. Okay, I can see intermediate too. You all are welcome. So what we're going to talk about today, it is important for a beginner trader. It is also important for an advanced trader. So make sure you pay attention and stay to the end of this section because there are prizes up for grabs. So I believe, some persons were able to win the quiz section during my colleague's time, that's Tunmise Olaoluwa. So obviously I have my own quiz section too. So if you didn't win there, maybe you can be able to, be one of the winners. So you're welcome to a section once again. So guys, we have promo code up for grabs. So if you missed that during my colleague section, it's here again. It's here again on our screen. So you can double your deposit with this promo code with Octa. So guys, Octa is a broker that is always ready to help traders. So, imagine, getting 100% bonus of your deposits. That is, wonderful. So you can just go through from what we have here from 1.5. You can see, log into your profile in the Octa trading app or our website, find the promo code section and the side menu, enter the promo code and tap activate, initiate a new deposit and claim your 100% bonus in the chat box, complete the deposit process. So guys, you can take a screenshot of this. This section, we're going to divide it into two. So the first, stage of this section, I will be talking about developing the right mindsets as a trader. So you can just take a screenshot of this so that when we go into live trading section, because I'll be dropping signals, we'll be trading together. So I'll be dropping signals. So make sure you are here with your live account. So when we go for a break, you can use that opportunity. If you've not funded your account, you can use that opportunity to fund your account and, get ready for the live trading section. So make sure you're ready during the time, guys. So a quick intro about me so that we can go straight, into what we have. Someone is asking like, how much can someone deposit? You can start from $100, $200. Just, put in an amount you can afford to lose, obviously. So a quick intro about me for those joining for the first time or you're joining my section for the first time. I am Happiness Hanson, professional forex trader with 4 years experience. I'm a trading coach and analyst, and my strategy is SMC. So which is actually what we'll be using to, analyze the market today. So if you're going to, stay here during my live trading section, we're going to navigate through the market, following my strategy, SMC, and you also get to understand the processes I follow when I am trading. So like I stated earlier, make sure you're here to the end of this section. Don't leave. So I also teach traders how to manage their money and find their trading style. So guys, we have the content that we have for today. That's trading with the right mindset, just like you've seen earlier. And after that, we'll have a break and, come back. Then we'll do our quiz section, just like it happened during the first phase of this section. Then after that, we'll go straight into trading, live trading and signals. So make sure you are here. Make sure you're here. Okay, guys, let's go straight into it. So guys, what we have on screen here, we have trading with the right mindset. Now, let's go through together. Trading is not easy, but you can make it easy for yourself when you are trading with the right mindset. Below are some eye openers that will help you in your trading journey. So before we go into, explaining more of the eye openers I have for today, understanding trading, Forex trading for the beginners here. Forex trading, let me just give a little meaning of, what Forex means. Forex trading, for us traders, all we do is to speculate whether a particular price is going to push up or it's going to push down. So in a situation where we speculate that dollar, for instance, is going to push up and it pushes up, we're making money. And if we speculate that dollar is going to push down and it pushes down, we're making money too. So I'm just trying to break it down, the literal meaning of what we do as forex traders. So we are more of speculating the price movements of different currencies. So in a situation where you speculate that it's pushing up and if it pushes down, obviously you're losing money. So that is forex trading for you. So, but before you go into, the aspect of trying to speculate, whenever I'm trying to teach new traders in the market, I always start with your mindset as a trader, and that is why we are starting with it today. I always start with your mindset as a trader because before you come into trading, there are things you need to get yourself to accept. There are things you need to, understand before you go into trading. Because I know most of us here, we heard about forex trading and we, rushed in without understanding some of the, key principles that we need to accept as traders. So I'll be listing some of them here, which we already have on the screen. So like I said, below are some eye openers that will help you in your trading journey. So number one, eye opener that we'll have there that we'll be looking at is every order has an uncertain outcome. Now, the second one that we have here is for you as a trader to learn how to embrace the risk. And then we have the third one, don't avoid what is unavoidable. So we'll go straight into it so that you will understand what I mean by these statements here. So from the first one that we have here, every order has an uncertain outcome. Every order has an uncertain outcome. So guys, let's read through together. If you want to be a good trader, you need to set your mind to understanding that trading deals with constant uncertainty. No matter the amount of studying, it will never be enough to help you be certain whether that the price will move in your direction or not. So all you just need to do as a trader is just think in probability. So guys, under this, as a trader, you just need to understand that no matter how intelligent you are, or if you come into trading, no matter how intelligent you are, you will not be able to, get the next line of action of the market. So whatever we are doing, that's why I started by saying that we traders, we speculate. So we are not more like so sure or 100% sure that, okay, what we are speculating is going to go to our direction. So that is what the statement is trying to, convey to you, for you to understand as a trader that no matter how intelligent you are, no matter how you've studied, it's just like me when I heard about Forex trading, I went on YouTube, to study, to understand every aspect of trading, the basics. After studying, I was more like feeling, ready and fulfilled to, come into the market to trade. But at the end of the day, I got to realize that trading deals with constant uncertainty. So no matter how, beautiful the setup you have or whatever you're seeing in the market, you may not know the next line of action of the market. That is the uncertainty that we are talking about in trading. So you as a trader, you need to, you as a trader or a beginner trader or an intending trader that wants to, start trading, you just need to get yourself to understand and accept this particular statement that every order has an uncertain outcome. So just come into trading with the mindset that if I speculate that a particular price is going to go up or is going to go down, I already know that it may go to my direction or it may not go to my direction. So once you get your mind, or once you get yourself to accept, this aspect of trading, you will get to trade with peace of mind. And, trading will not be difficult for you, because I am not here to tell you that trading is easy. Trading is not easy, but once you get to accept all these things that, comes with trading, you will get to make it easy for yourself, and trade with peace of mind. So get to know this, that every order in trading has an uncertain outcome. So as a trader, just think in probability. So the next one we have here is for you to embrace the risk as a trader, for you to do what? Embrace the risk. So let's read together. Of course, you are taking a risk once you place an order, but that doesn't mean you are correspondingly accepting the risk. All orders are obviously risky because the outcomes are, all orders are obviously risky because the outcomes are probable, not guaranteed. So the question is, do most traders really believe they are taking a risk when they place an order? Have they really accepted that the order has a non-guaranteed probable outcome? So these aspects of you embracing the risk, just like I stated, if you're coming into trading, for you to hear trading, that simply means you must have seen someone talking about it, stating how he or she has been making so much money, because that is what most of us, traders will put out there, more like to, bring you into trading. Now, once you see that, you as a human being or, someone that you've not been into trading, if you see that type of, enticement, you come in as a trader, you are coming in with the mindset of, okay, let's start making the money. Where is the money? Let's start making the money. But this is what you need to understand. this is the reality of trading, that you really need to embrace the risk. You really need to understand that if you are coming into trading, whatever capital you want to come in with, just know that the capital is at risk. So that's why you need to, ask yourself different questions before you come into trading, get to understand if you are ready. Now, being ready is not just, I'm fully ready to, jump in. Where is the money? Let's start making the money. You need to ask yourself if you're ready, the capital you want to risk. Are you ready to risk that capital? Are you ready, or are you willing to, do away with that capital? Because once you get that type of, readiness in you, the anxieties of trading will reduce, because these aspects of trading that I am currently talking about is, if you get it during the early stage of trading, it will help you in the long run, because trading comes with a whole lot of, anxieties. So if you get to accept all those things early enough before you start trading, you will get to reduce so much pressure when trading. So when coming to trading, accept the risk. Accept the risk. Any capital you are mapping out, it's just like I can see in the comments, most of you are talking about how much can I fund, most of you are just asking me how much can I fund my account with, because I told you guys, next section, we are going into live trading and we're going to make money together if we get the setup we're looking for. So just as you're funding your account, be ready to embrace the risk. And that was also why I gave the disclaimer that if you're funding your account, make sure it's the capital that you're willing to risk. So embrace the risk, accept the risk as you're coming in, accept it, and know that that capital is at risk. Because remember the first statement that I stated, trading is, deals with constant uncertainty. So we are going to speculate. Well, in a situation where our speculation is right, we make money. And if it's wrong, just know that we're going to lose money. So that is the risk aspect of trading. And you need to accept that if you want to do well in trading, you need to accept that. Because all you need to understand is even the pro traders, they lose money too. So you need to understand that, accept the risk, because this is actually one of the reasons why most traders give up. You will see that some people will say that, I tried trading, but it didn't work for me. That's because before you came in, you were not able to, embrace the risk. You were not able to ask yourself the question, am I ready financially, to come into trading? Now, when putting in your capital, you obviously need to put in something that even if you should, if it should leave you, it will not throw you off balance. So that's just all you need to understand by embracing the risk. Put in an amount you can afford to lose, and just know that any capital you're putting in is at risk. Okay, guys, the next one we have here is don't avoid what is unavoidable. So let's read through so that you understand what the statement means. It says, if you are afraid of being wrong or losing money, it means you are not ready to be a trader. It's, it's very simple. I'm going to read that again. If you are afraid of being wrong or losing money, it means you are not ready to be a trader. In trading, your fears will act against you in such a way that you will cause the very thing you are scared of to happen. If you're afraid of being wrong, your fear will act upon your perception of market information in a way that will cause you to do something that, ends up making you wrong. So just learn to be a good loser. So guys, putting more light on these particular statements, like I said, that we were just coming from, you accepting the risk as a trader by funding, the capital that you're willing to risk. Now, most people will accept that aspect and, fund a particular, let's say a specific amount of money, fund that. But when they are placing trade, inside them, they just want the price or the market to move to their direction. They don't want it to even go against them. They don't even want to see drawdown or anything. They don't want to see that move. So if you are having that type of mindset as a trader, just know that you're not ready. You're not ready yet. Because if you are coming into trading, you must be ready to be wrong. You must be ready to be wrong. Now, what makes you a good trader is you in learning how to be wrong the right way. I don't know if you understand what I mean by that. You just need to learn how to be wrong the right way in trading. So as a coming into trading, you should just get ready because number one, you are accepting that your capital is at risk. Now, all you now need to, put into practice is to learn how to utilize that particular capital well when placing trades. You just need to know that it deals with probability. So if price moves your direction, you make money. If price, goes against you, you lose money. Now, most of you may be asking, how do you learn how to be wrong the right way? So in the comments I was going through, someone mentioned risk management here. That is when risk management, comes in. That is when risk management comes in, because that is how you learn to be a good loser. If you're trading, you already have your capital, and obviously you should not go all in just, a trade. The risk management should come in before you trade. You need to know how much you're risking on that particular trade. Know how much, if the trade should go against you, you need to know how much you are losing and how much you're going to get from that particular trade. That is how you get to, remove that aspect of, being scared of losing your money, because this is actually, the aspects that do throw some traders off balance. Most traders, they have started trading, but they don't just want to be wrong. They want that money. It comes with, how you introduce yourself into the market. If you jump all these steps, these psychological aspects of trading, and you just, rush into how is it done? Let's get it done. You get a strategy, you just start trading. Now, this particular aspect of trading, this psychological aspect, most traders will get to, understand these aspects of trading when they've already started trading, because you get to learn this or you experience all these things when you've already started trading. Then some others, few may, get to understand this aspect of trading before they come in. But most traders, they get to, trading itself will teach them this aspect of trading. It will teach you this psychological aspect of trading. That's indeed, because we may be trading with the same strategy, and let's say I'm doing well and you are still struggling. So what do you think is the problem? What do you think is the problem? Because as I stated that my strategy is SMC, and someone was asking what's the meaning of SMC. SMC simply means smart money concept. We'll go into that. We are still in the stage 1 of my section. We broke it down into 2. Still in stage 1 of my section, and after that, we're going straight into trading. And soon we'll be going for a break. So I will announce that soon. We'll be going for a break, and once we come back, that is the quiz section. So don't go too far. Be very active, because you may be able to, be, one of the winners for my quiz section. So like I was saying, we may be trading with the same strategy, and I am making money, I'm doing well in the market, but you are not doing well in the market. So now you now need to ask yourself, what is the problem? What is happening? Now, the problem is actually your mindset. Because me as a trader, the way I see trading, before, most beginners will start seeing trading like that, you just need to get to accept a whole lot. Because as I'm dishing all these things out now, as I'm dishing all, these aspects of trading out now, you just need to know that I have experienced, all this. So for me now, I got to learn these aspects of trading during my process of trading. Like, I experienced it as I started trading. I did not, get to understand this. I came in with the mind of let's start making money. Let's start making money. Where is it? How are we doing it? Okay, I need to learn. Okay, thank you. All those things. I was just haste and ready to make money. And at the end of the day, I was humbled. So I got to realize this aspect of trading. I got to realize this aspect of trading, and it has helped me a lot. So in the aspect of where you are trading the same strategy with someone and the other person is doing well and you're not doing well, it's just your mindset. There are still some things, some things that you've not accepted as a trader, and you just need to, force yourself, this time around, when it comes to the trading psychology aspects, that's you being that, disciplined as a trader. You just need to force yourself to do it. Because if you are unable to force yourself to accept this, you will keep struggling in the market. That is when you'll be finding it difficult to, hold on to your trades. Some of, the different things I look for when trading, because there are a whole lot of anxieties that will come when you start trading for the beginners. And for those that are trading already, you should understand what I'm talking about, because there are a whole lot. I know most of you here, if I ask the question, if you are able to hold on to your trades, like if you're able to hold on to your trades, like can you hold your trades for long? Most of people say no, that once is a little bit in profit, they will get scared and they will just, close the trades. Now, do you know that there are traders that can hold on to their trades, they can see profit running and they'll be looking at the profits. Okay, I'm still waiting for you to get in my direction. Now, ask yourself, when can I get that type of, courage to hold on to my trades like that? They are different. These are just, that simply means the mindset of that particular trader has changed. Now, the mindset of that particular trader has changed. So that's just all you need to understand. So guys, during our next section, we'll be having the quiz section. So let's just go for a little break now. We'll go for a little break and then we'll come back. So just have all these things in mind, what I've stated. We'll go for a little break and we'll come back for the quiz section. So stay tuned, don't go too far. Yeah, okay, guys, you're welcome back. Hello, guys, you're welcome. Are you with me? Okay, guys, are you with me? So quickly take down the instructions for my own quiz section. Just take down the instructions. Don't rush. I was actually laughing during the break. So I was stating question 1A, question, that was funny. Okay. So for my quiz section, I have 4 questions. I have 4 questions for you to answer, but you are not expected to answer differently. So all I need to do now is I will read the questions, one after the other. All you just need to do is, pay attention to question 1. I'm not going to go back to any question. So I will read question 1. You should just be holding your, your keyboard. Once I read the question 1, you write out the answer. You write out the answer and wait for question 2. You write out. So you just need to answer in bulk. You don't need to drop them one, because I'll just be, picking one winner. That's all. Just one winner. So you don't need to start, let's say if you see question 1, you don't need to drop the answer immediately. Just pile them up. You just need to drop question 1, question 2, question 3, and question 4 answers at the same time and drop it. The first to do that will actually be the winner of my quiz section. So guys, don't rush too much. Do not rush too much. Pay attention to the question, pick the right answer, and wait till I'm done reading out all the questions. Then you will not drop your answer. So we are moving over to the question 1. So I'm going to read, I'll just read each question, 2 times, and you just need to pick your answer. Someone say answer your book. Okay. We are looking at question 1, guys. Question 1 is up on the screen. So the question, to be a successful trader, you have to be sure and certain of what the market is going to do next. True or false? So if you think it's true, you just write question 1 true. If you think it's false, you just write question 1 false. So I will read that again. To be a successful trader, you have to be sure and certain of what the market is going to do next. True or false? True or false? Okay, that is it for question 1. We are going over to question 2. So make sure you've gotten question 1. To be a successful trader, you have to be sure of what the market is going to do next. True or false? Okay, straight to question 2, guys. Okay, we are looking at question 2. What is a PEEP? I think my questions are simple compared to my colleagues during the first section. My questions are just, straight to the point. Remember, follow the rules, follow the rules. So number 2, what is a PEEP? A, percentage in profit. B, price interest position. C, percentage in point. So I'll just read number 2 again, then we'll go straight to number 3. What is a PEEP? Percentage in profit. A. B, percentage price interest position. C, percentage in point. Okay, guys, let's head straight to question 3. So question 3, what is the dollar equivalent of 2.82 lot size? If you are trading with 2.82 lot size, how many dollars are you risking per pip? Just trying to rephrase the question. What is the dollar equivalent of 2.82 lot size? What is the dollar equivalent of 2.82 lot size? A, $282. B, $28.2. C, $22.8. So guys, I can see you all dropping, dropping your answers. Question 3, you drop the answer. Question 2, you drop the answer. Remember the instruction. You drop your answers in bulk. So have that in mind. You drop your answers in bulk because I'm just picking one winner, just one winner. You drop your answers in bulk. So you don't need to be dropping them one after the other. You tie them up and drop them. Okay. Let me repeat question 3 before we head straight to the last question. Question 3, what is the dollar equivalent of 2.82 lot size? A, $282. B, $28.2. C, $22.8. Okay, guys, we're going straight to the last question. We're going straight to the last question, guys. We're looking at question 4. What is the non-farm payroll? Like, what is non-farm payroll? What does it entail? You hear NFP for most of you that have been trading. So what report comes out during NFP? What result or report comes out during NFP? So A, report on prices. B, report on inflation. And C, report on employment. What report comes out during NFP? Let me rephrase the question. So is it report on prices, reports on inflation, or reports on employment? So guys, remember, drop your answers in bulk. So the moderators will help me pick the winner. Remember, I'm just taking one winner, one. So the moderators will help me pick. So guys, it's time to check out the correct answers. Let's know the person that actually got it. So I'll be showing the correct answers soon. Are you guys ready for it? Ready for the correct answers? I can see most of you are still dropping your answers. Okay. All right. These are the correct answers. For number 1, the correct answer is false. If you can remember the question, you don't need to, as if you want to, as a trader, you don't need to be very certain of the next line of action of the market. So the correct answer for number 1 is false. Then for number 2, the correct answer is C, percentage in point. Then for number 3, the correct answer is B, $28.2. Then for the last question, the correct answer is report on employment. So the moderators will help me pick just one winner that, if you're able to drop the answers, just as you can see it, as you can see it on the screen, if you're able to drop your answers like this, then okay, guys. That's for my quiz section. So before we go straight into the live trading section, that is the next batch of this section, before we go into that, if you have questions, concerning the discussion we just had, some of the things you just need to accept as a trader, before you start trading, some of the things you need to force yourself to accept. So if you have questions, it's time for you to drop them. If you have questions, you can drop them. But if you don't have any, we will be going for from here to the next badge of our discussion today, which is our live trading section. So if you have questions, it's time for, questions concerning the first batch that we had. If you have questions, you can go ahead and drop that. But if you don't, you can just use this time and, get your account ready, because we are going to the charts. So if we get a setup we're looking for, we're going to make money here together. So hope your account is ready. Okay, I think we have one question from David. He said, does it mean we cannot be certain of the market movement? Just like I explained, the first statement I made when I was talking about you understanding the constant uncertainty that comes with trading. Now, like I said, when trading, we Forex traders, we speculate, we are just speculating. We're not 100% sure, no matter the strategy you're using. We're not 100% sure that the price is going to go to our direction. So we employ our strategy, we use our strategy to, do our speculations. So our strategy can, make us speculate that, okay, price is likely going to move to our direction, or it's likely going to, push down. So what we are doing is more of speculation. So trading, deals with probability. We can speculate that it's going to go up and it goes down. It will go and hit stop loss and bring you out with loss. Which is what we are going to do now as we are going to the chart. We'll soon enter the second batch of this section. We'll go to the charts. We'll do our speculations, and if we see setups, we'll trade together, and at the end of the day, if the market obeys, we'll make money. If it does not, we'll console ourselves. So that is it. Okay, so May or Sunday saying trading is based on speculations. Yes, with your strategy. Okay. Okay, guys, let me know if you can see my charts. Let me know if you can see my charts so that we'll get straight into it. Okay, I guess we have a winner already for the quiz section. Congratulations, one per Barnabas. Congratulations. So guys, it's time to make money. It's time to look for money in the market and make money together. Okay. So we're looking at GBP JPY. We are looking at GBP JPY now. So before we go into, doing our analysis or looking for setups on the trades we need to take now, I'll quickly give you guys a breakdown of my strategy, how I look at the charts, and how I make my analysis, things I look out for before I trade, which is actually, you've gotten the first batch of lessons, how you need to think as a trader. So now, if you've gotten that aspect, this is now how you need to look at the charts. This is how I look at the chart. So just pay close attention to understand my strategy, because you may be hearing some of the terms, and if you didn't pay attention, it may be confusing to you. So before I take any setup or place any trade, these are the things I look out for. So the first thing I need to understand as a trader is the market structure. The first thing I need to understand as a trader is the market structure. So when it comes to the aspect of market structure, all I need to see, so guys, I am a day trader. So before I come to the chart to take my trades, I need to understand where the market is directed to. Is it pushing up, or is it pushing down? Or is it ranging or consolidating? So when you're looking at, or you're trying to understand market structure, if you're trying to understand market structure, it simply means you want to point out whether the market is pushing up or it is pushing down. So where the market is pushing up, we can call that a bullish structure or a bullish trend. And where the market is pushing down, we can call that a bearish structure or a bearish trend. Then when the market is more like consolidating or ranging, we can call that a sideways movement. So guys, pay attention to this, that using my strategy, that is SMC, smart money concept, using my strategy, if the market is pushing up, okay, I can, look out for setup. So when the market is pushing up, that simply means I'll be looking out for possible buy entry just to follow the trend. Now, if the market is pushing down, I'll be looking out for possible sell entry just to follow the trend too. But in a situation where the market is ranging, I stay off. In a situation where the market is ranging, I stay off. So have that in mind. My strategy, do not, look for setup with my strategy when the market is ranging, because my strategy works more when there is a direction in the market. So that is the aspect of the market structure. So before I take trades, I need to go down to the higher time frame, do my top-down analysis to understand the direction of the market. And from there, I will now get a bias. Now, once I understand the direction of the market, the next thing I need to see is break of structure. That's the next thing I need to see, break of structure. But we can call that BOS in short form. So the next thing I need to see is break of structure. So guys, I'm trying to, make you understand, the theoretical aspects of my strategy before we head straight into analyzing the chart. So the next thing I need to see is break of structure. So break of structure simply means when, price is clearing out recent highs or recent lows, just recent key levels or recent lows. When price is clearing out, if price should, clear out a key level to the upside, that simply means we have a break of structure to the upside. Then if price should clear out a key level to the downside, that simply means we have a break of structure to the downside. So that is what I mean by break of structure. If you go to the chart, you'll still see the practical aspects of it. Then the next one, once you get the break of structure, the downside. So you can remember when I was talking about market structure, I said when market is ranging, you just need to stay off and observe to know the next line of action of the market. Is it trying to break to the upside or is it trying to break to the downside? So whenever that consolidation is happening, there must be an impulsive movement. Because when the consolidation is happening, that's more like a fight between the bulls and the bears. So the winner is actually the person that will break out. The winner will be the person that will break out. So in a situation where there is a breakout to the upside, a break of structure to the upside, that simply means we have a bullish run. Where there is a break of structure to the downside, that simply means we have a bearish run. Now, that consolidation that happened before that impulsive movement will serve as our origin. That will serve as the origin I am talking about here. That is where you will now highlight as your point of interest. Now, what I mean by point of interest is where you will be looking to enter a trade. Where you will be looking to enter a trade, that is where you will now highlight as your point of interest. So you will still see the practical aspect of it once you start, analyzing proper. So once you get the origin, the next thing you also need to look out for now. Others I'm going to list now. This is actually some other confluences that will make my origin valid. So if I get to understand the market structure and I get to point out the most recent break of structure from my entry time frame, and I point out the origin that caused that particular break of structure, there are other confluences I need to see close to my origin that, will help me, know that my origin is kind of valid. So it adds more validity to the origin once I map it out. So the first one is liquidity. That's the first one, liquidity. So when it comes to liquidity, just, to break it down, the literal meaning so that everyone will understand what I mean by liquidity. Liquidity simply means where money is sitting. Now, as the price is moving, as the market is moving, that simply means traders are putting in money into the market, causing, liquidity in the market. So for my origin to be valid, I just need to see a liquidity zone present to my origin. Now, a liquidity zone simply means where, a trader, let's say support and resistance level trader, trend line traders can see, where a trader can see and, think of placing trade on a particular level. So I need to see that close to my origin, then that will add or make my origin, more valid. I need to see a liquidity zone present. So I will also give a chart representation of that so that you will understand it. So liquidity, it adds more momentum to the market. So what it does to my strategy is I want market to sweep that particular liquidity. That's when, that's why sometimes most traders, you will see a trader complaining that he or she, you took a trade and you were stopped out and the price now moved in your direction. That simply means your entry, you took your entry from a liquidity zone. So for market to move, it needs to sweep liquidity that will now fuel the movement. So that is it. It needs to sweep liquidity, to give it the momentum it needs. So I need to see that present to my origin, because if it's not close to my origin, that simply means my origin will be treated as a liquidity. And that is when markets will likely, stop me out and still move to my direction. That's because your entry was taken from a liquidity zone. Okay, so once I see the liquidity zone, another thing I need to see, very close to my origin is an imbalance. Is an imbalance. So
The literal meaning of an imbalance simply means the gap price creates on the chart. The gap price creates on the chart. So I will still give you the chart representation of that so that you understand it more. It's just the gap price creates on the chart. So the idea behind it is that the bulls and the bears, they're meant to have, equal movements in the market. But in a situation where there is an unequal movement in the market, it creates an imbalance in the market. So SMC traders, we can call it fair value gap. So that's why maybe you've seen a trader's chart and you've seen FVG. So that's what it means, fair value gap. Or you can also call it imbalance generally. Or you can call it, inefficiencies of the market. There are just a lot of them, you can call it. But we can generally call it during this section an imbalance. So that's the gap price creates on the chart. In a situation where there is a long candlestick movement and price fails to, cover up the gap created by that particular candlestick movement, and then it will just be moving up, or it will just be pushing down. That creates an imbalance. Now, having in mind that I do not pay attention to, any imbalance I see on the chart. I only pay attention to the imbalance that is closer to my origin. I only pay attention to the imbalance that's, very close to my origin. That's the imbalance I pay attention to. So guys, looking at all this from the beginning to the end, this is just my strategy in a nutshell. And that is how we'll be looking at the charts now. So if we analyze, different currency pairs and we'll see possible setups, guys, we are placing trades immediately. We are placing our trades together and we're making money immediately. So like I said, once I see the signal is dropping, we'll make money together. We'll make money together if the market obeys. Okay, so before we go into that, let me quickly explain this too, because I'll be using this term so that it will not confuse you, which is what I call change of character. Change of character in a short form. Okay, guys, when it comes to change of character, just as the name implies, change of character simply means when there is a change in market structure. So let me just give an illustration. When there is a change in market structure, that's what change of character means. Change of character, if the price is pushing up, then there's a retracement, then we have a break of structure. So I just want to use this drawing to explain everything I've been listing before we now go into the charts proper. So let me use this graphical, this illustration to explain my strategy too, so that you understand. So this is a key level, and you can see price pushed up, and we have a break of structure. Now we have a break of structure to the upside. That simply means if we are looking to map out the origin that caused the break of structure, this is actually where the break of structure, started from. So this would be the point of origin, and we'll map that out as our point of interest. We'll map that out as our point of interest, which is what I call POI. Now, mapping it out as a point of interest, that simply means you are waiting for another retracement into that level for you to buy, because we are looking out for more buys. Now, the idea behind it is that the, consolidation that happened there before an impulsive movement, whenever there is, that impulsive movement to the upside, that simply means an order has been placed there. So we're expecting market to come back and finish up the order, trigger all the orders that have been placed there. So that's just the idea, which is also the idea of order block, which is our origin. So we have our point of interest mapped out. Now, for this particular point of interest to be valid, for it to be valid, we need a liquidity zone to be present. Now, liquidity zone can be something like this. Let's say market was trying to come down and then it's created a key level here, you know, to the upside, something like this. I'm just giving an illustration. You know, it's created a key level and maybe pushed back up like this. Now, in this situation, this particular level here has given, you know, it stands as the liquidity zone very close to my origin. So what that means is that most traders seeing it as, you know, market has reacted from this level and, you know, it has pushed up. Most traders will map that particular level out and they'll be looking to take a buy from that particular level if price should come back to that particular level. So as traders are placing their buys here, that simply means they are putting in money into the market, which is creating liquidity. And since we have this particular point of interest here, I will not be looking to place trade from this particular level. I will patiently wait for price to get to this level before my entries will trigger. So let me also inform you guys that my strategy deals with a whole lot of patience. So you need to wait. You need to cook, you know, cook and wait for it to be ready. So you don't need to rush. Cook and wait for it to be ready. That is my strategy. You cook and wait for it to be ready. So, you know, when you wait for the right setup, that is, you know, when you're trading the right setup, your A+ setup, you know, that is when your account will be going. You don't need to force out entries on the chart. You cook it and wait for it to be ready. That is it. So I have my origin here that caused this particular break of structure. So that is what I'll be waiting for market to tap into that zone. But obviously there are traders with their different strategy, you know, traders will be placing trades here because we may have traders that may not wait for price to get to this level. They'll start placing their buys here. And as they are placing their trades, they are putting the money into the market. And obviously their stop loss will be below. So in that situation, this level, I will treat that as a liquidity zone. And I mark it out with a dollar sign, which shows that money is sitting there. Shows that money is sitting there. Then, after that, we'll look out for the imbalance, just like I explained. You look out for the imbalance. Now, imbalance simply means the gap this movement has created. You will get to understand this one more once we start looking at candlesticks proper. But let's just treat this level as an imbalance. This gap from here to here as an imbalance. So this would be the imbalance. So what I'm expecting is for price to retrace, clear out this particular level. Once it clears out this liquidity zone, it will close up the imbalance, then tap into my zone. Once it taps into my zone, it will not have any other choice than to push up to my direction. So guys, this is just an illustration explaining my strategy. This is just an illustration explaining my strategy. So once it pushes up, you can see we'll get a new break of structure to the upside. So once we get that, that simply means if we get a new break of structure to the upside, that simply means this particular origin, have this in mind that once a particular POI or a particular origin has been mitigated, once that particular origin has been mitigated, it's no longer valid. So if we have a new break of structure, we'll be looking at the new origin that caused that particular break of structure. You will wait again for a retracement before you catch it. I know most of you may be asking, why don't we catch the retracement? And, you know, when trading, you just need to have reasons for whatever you're doing. If you're trying to catch the retracement, why do you want to sell? So that's just the idea behind you having a strategy, because your strategy will give you reasons why you are thinking of buying or why you are thinking of selling. That is what your strategy will do for you. Now, in a situation where you're trying to catch the movement both ways, you're trying to sell, you're trying to buy. For you to sell, you just need to, or for you to catch the retracement, you just need to make sure you have reasons for that. You just need to make sure you have reasons for that. And that is when, change of character comes in. Because in a situation where, as price is pushing up, let's say it comes back down, taps in, and then we have a new break of structure, something of that nature. But let me just clear out this origin and explain change of character. Now, we have new break of structure. So the idea is once price gets into the origin, this particular origin, once price gets into it, the idea is for, price to mitigate that particular origin and still push up. But whenever price gets to the most recent origin that caused a break of structure, and instead of mitigating that origin to push up, it breaks that particular origin. That is when change of character occurs. So change of character, just as the name implies, simply means that the character of the market has changed. The character of the market before was actually a push to the upside. It was breaking structure to the upside, but now, excuse me, but now it has changed into breaking structure to the downside. So whenever it's, breaks structure to the downside, so you can see we've gotten the change of character. So that simply means price is no longer breaking structure to the upside. It has changed into breaking structure to the downside. And what do you need to do? You change your bias immediately. So your bias before was, you were looking out for a buy. Now, once change of character occurs, you will start looking out for a sell. So for a change of character to happen, that simply means we now have a break of structure to the downside. We now have a break of structure to the downside. So all you need to do is you now map out, still follow same strategy. You map out your point of interest, wait for retracement, because obviously market will retrace. You wait for retracement, you wait for market to mitigate your zone. You still need to see your liquidity zone. It can just be, one key level. It can be M pattern, or, just it may be a little consolidation that is very close to your origin, which will serve as your liquidity zone. Then you just need to see that presence. And after that, then market price will need to sweep that particular key level to tap into your zone, and then you sell to the downside. So guys, this is my strategy in a nutshell. I've given us the theoretical aspect of my strategy, and I've given out an illustration explaining my strategy. So let's go into the chart and do our analysis and look out for possible entry. Hope you guys are ready. Let me clear this. So obviously, as we are analyzing the charts and as I'm explaining the strategy, analyzing the chart, if you have any question concerning my strategy, for this second batch of, my section, you can still drop that in the comments. You can drop your questions. I can see one. I can see one already. So once it's time for question and answer section, I will attend to that. But for now, let's do a quick analysis. So guys, we're looking at GBP JPY. Let's get to understand the market structure on GBP JPY. We're looking at the daily time frame on GBP, JPY, that is British pound and Japanese yen. So guys, looking at this, let me get to hear from you guys. I believe I have some traders that do understand market structure already. So from what you can see here, I didn't draw anything, I didn't put anything on the chart. So from what you can see on the charts, do you think GBP USD is bullish or bearish? Let me hear from you guys before we start, reading the structure together to, understand the direction of GBP JPY. So do you think GBP JPY is bullish or bearish? Now I'm doing this to make sure that you all are following the analysis. You are not just waiting for when I will say, okay, buy or sell. So I want all of you, I want all of us to follow, understand the nook and cranny of whatever I'm doing here, so that it will help you even after this section when you're looking at the charts, you get to understand trading. So do you think it's bullish or bearish? Okay, I can see bullish in the comment. Okay, so let's check if that is correct. Let's check if GBP JPY is actually bullish. Now we're doing the first aspect of my strategy, which is reading the market structure. We need to understand the direction before we get a bias or we take a bias. So doing our analysis from this particular level, we can see as price got here, market got here, we have this break of structure. We have this break of structure here. We have this particular break of structure here. So price cleared out this particular key level. So you can see this key level. It's created a sell. From there, that was a sell. But when price came up, reacted, and then we got a break of that particular key level, which is actually the meaning of the break of structure I'm talking about. So I'm giving you guys the, the chart representation of it now, which is actually the break of structure I'm talking about. So now, guys, we have a break of structure, and we also have another break of structure here to the upside. We also have another break of structure here to the upside. So now, looking at the movements that we have here, I can agree with those that stated bullish in the comments, because that is what I can see. We are looking at the daily time frame, so that is what I can see. GBP JPY is bullish, although we are seeing this retracement. This retracement is coming down. Now let's just map out all the origins present on this chart. This is an origin in a way that if price should come back into this particular level, we'll be looking to buy. This is an origin from the daily time frame. This is another origin. This is another origin from the daily time frame. So if I'm to take an entry from the daily time frame as we're looking at it, but that is not where I take my entries from, because I'm a day trader, so I take my entries from 15 minutes. So all I do, if I'm looking at the higher time frame, all I'm doing there is to just understand the direction, to understand where market is directed at. Then I'll take a bias and move straight to my entry time frame, following what I've seen, on the higher time frame. But looking at it now, following my strategy, just like I explained, we have a break of structure. This is the origin that caused the break of structure, and you can see we already have a key level present, which is where market is reacting. We have this key level present, so that means some traders are placing a buy at this level. But for me, if I'm looking to buy, I will patiently wait for it to get here before I buy. So this particular level will be treated as a liquidity zone, and I'm not willing to start placing a buy at this level. Yes, this particular level, yes, it's a support level. Most traders will be looking, to buy at this particular level. If I even extend this key level like this, if I extend it, you can see most traders, for break and retest traders, you can see we already have a break and market is retesting the broken zone. So a lot of buy setups will be here. But for me, I want to buy too. So this is where I'll be looking to buy, following my strategy. Now, understand this, that for those trading support and resistance level, or for those trading any strategy of your choice, just know that any strategy can work for you if it suits your trading personality and your trading style. So this is my own strategy and it works for me. That is why I am, proudly and boldly teaching you guys how I use this to make money. So, but that does not mean that if you are trading a different strategy, that what you are doing is wrong. No. Just whichever strategy you have for yourself, use it and make sure you're making money. That is what matters in the market. There are some traders that are making a whole lot of money by just trading with trend line. They don't need any stress. They'll just put their trend line price will retrace back into it. They will just be making money. So it all depends on how well you utilize your strategy. Just make sure the strategy, suits your trading style and everything, and you're making money with it. So once your strategy has the edge, stick to it and make money with it. So this is my own, and I'm making money with my strategy, my win rates, top notch. So that is why I am teaching you this particular strategy. If you want to use it, obviously, first you need to practice with the strategy. You can do that in your demo. You practice to understand everything that this strategy entails before you apply it in your real account. So, like I was saying, most traders will be looking to place a buy at this level, but I'm going to treat this level as a liquidity zone because I'm not interested in buying here. Why? Because I think this is the main point I should be looking out for a buy. This is the main point of interest for me. So this particular point of interest here will be my liquidity zone, which this would be my liquidity zone here, which I'll map out with a dollar sign. That simply means money is sitting here. That will be my liquidity zone. Now, where is the imbalance to complete all the conferences I need to see before I start taking trades? Now, guys, look closely. That's why I'm zooming this in. So look closely. You will see that after this consolidation, the impulsive movement started, which cleared out this structure, causing a break of structure. So you can see after this particular candlestick, this one, we got another bullish candlestick that opened, and you can see where it closed. It closed here, and then another one opened just where the last candlestick closed, and we got another opening which tried to cover up the gap created by this long candlestick, but it didn't finish it up. So you can see from here the movement from here to this particular level. So you can see that we have this gap from this to our point of interest. So this particular gap that market didn't fill up is what I call imbalance. So I need to see this present or very close to my origin. It adds no more validity to my origin. I need to see that present to my origin before I can decide to trade. Now, guys, this is my own A+ setup. Once I see this on the chart, I don't need to start thinking again. I don't need to hesitate. I don't need to waste time. I will just do what? put my pending order. I'll just put my pending order. You know, then my stop loss will just be a little bit below the POI, that is the origin, and then my take profit will be at a point of reversal. So once I see this particular setup, my entry time frame, I don't need to waste time. I am taking a buy. So you need to understand that this strategy is not just for day traders. It can work for you as a day trader. It can work for you as a swing trader. It can work for you, you know, any trading style. It can work for you. So if you are the type of trader, you take entries from the daily time frame. This is, you know, from what I'm seeing following my strategy, this is a nice setup for you to pick. So we should be looking for a buy from this particular level because all the conferences I need, they are intact. Now, this is also a lesson to anyone there. Let's say you have your strategy and you're always having this issue of you make your analysis, but to place your trade, it's kind of difficult for you because I know most traders may be going through that. You make your analysis and watch your analysis, you know, move in your direction without you. They're not making money following the analysis you've made just because you are scared that the trade may end up as a loss, or you are scared that it will not move in your direction or something of that nature, or you don't trust your strategy at all. That's actually, you know, some of the reasons that will, you know, make a trader not to, you know, place your trade after doing your analysis. That's actually one of the reasons. Number one, you may not you don't trust the strategy yet. You don't know what the strategy is capable of doing in the market. So even after mapping it out, you are scared that it will still move, it will still go against you. And then that atom of fear of being wrong is still there. You've not accepted the fact that trading deals with uncertainty. So what you just need to do is do your speculations and leave the rest for, you know, whatever the market wants to do. So that's just all you need to understand. So if you take entries from the daily time frame, this is a signal for you. If you take entries from the daily time frame, a swinger here, a position trader, this is a signal. So all we're expecting is a little more push to the downside into this level, and we are buying to catch, you know, the trade all the way to this level. So we're looking at close to 386 pips here, and then the stop loss. This is just 1:2, or approximately 1:3 risk to reward ratio. The stop loss is, you know, 147 pips. So that is for, like, if you're looking to take entries from the daily time frame. Now, having that in mind, with this, we already know the direction of GBP, JPY. So all I need to do now, so if you want to wait for this particular setup, you can just take a screenshot because I want to move over to my entry time frame, that is 15 minutes. Let's see if we can get a buy setup from there and take a short-term trade on GBP, JPY. So if you take entries from the daily time frame, you can just take a screenshot of this. This is a probable setup. No, a possible buy on GBP, JPY. Okay, so I'll be clearing that. Let's move to my entry time frame. Do we have a possible setup for us here? Do we have, I think I can see, I think we have a lookout here. So guys, we're looking at 15 minutes time frame. We already know the direction, which is we are bullish. So from what I can see here, guys, we have a break of structure. We have a break of structure here. And then you can see the origin all this consolidation happened, and after that, we got what these impulsive movements that cleared out the structure. So that's the impulsive movement. Now, all we need to do is to map out our origin. Now, refining it to an order block, when mapping out your origin, if there are a whole lot of origins, all you just need to look out for is the last candlestick before the impulsive movement. You just highlight that particular candlestick and extend your zone. So guys, we have a setup. We have a setup that we need to wait for on GBP JPY. Okay, we have this record structure here. And then this is the origin. Now, all our conferences, I can see all of them intact because after this particular candlestick, you can see from here to this level, we have this gap, which is creating our imbalance. So we have our imbalance present. And then we have our liquidity. We have our liquidity zone here. So guys, we have a possible buy setup too from the 15 minutes time frame. So if we are to place our SL will be a little bit below this particular origin. So if we are to extend it, it can be a little bit below this, the last swing low before the impulsive movement. So our SL will be, somewhere here. So this will be our SL. Then our take profit, we are looking at the retracement zone where price got to and started retracing. So that's going to be our take profit. So guys, this is a possible, it's going to be a pending order. So we're going to put a pending order on GBP JPY. That is a buy limit. So all we need to do is to patiently wait for price to get to this level and we'll buy and take our profit here. It's just a 1:2 risk to reward ratio. So we are risking 1% to catch 2%. That's what the setup gives. So I'll be dropping the coordinates for those of you that, if you want to trade with me, I'll be dropping the coordinates. It's a buy limit, a pending order on GBP JPY. So we just need this, mitigate this order block, and we'll move to the direction. So for our so this is, let me just write out the signal. Buy limits. Buy limits on GBP JPY. So guys, remember, apply proper risk management. You know the amount you have in your capital. As your capital, you know the amount you have there. So just apply proper risk management when taking this trade. Don't over leverage. So we have a buy limit, entry price, or let me just, entry price EP. Our entry price is 188.769. That is our entry price. Then our take profit, TP. Our take profit, so let me get the number. Impute. Our take profit, we are looking at 189.5 544. They're looking at 189.544. That is for our take profit. Then for the stop loss, SL, the coordinate for our SL is 188.453. So guys, apply proper risk management. This is a stop loss of 31 pips. So you know the percent you're willing to risk from your capital. This is the signal. So it's here on screen. Entry price 188.769. We're targeting this TP, and this is our XL. So guys, that's the setup we have on GBP JPY. So just put your pending order. It's not an instant execution. So pending order for beginners that don't understand, pending order simply means that where you are looking to take shares from, no price is not there yet. So your order will be pending. It will hold on until price gets to that level and execute that order. So that's pending order. Why instant execution simply means, as we're looking at the chart, and this is where the current market price is, if we want to buy, we are entering immediately. Our order will not be pending. It will just move in our direction. So here we'll be using the pending order buy limit. Buy limit simply means we want to buy, but not at this particular level. We want a slight retracement to this level before we will start buying. So let me just give you guys time. For those placing the trade with me, you can just go ahead and put your pending order, and then we'll look at another pair. Okay, guys, I'm also trying to put the pending order here. So let's just use 2 minutes for that. So remember, apply proper risk management. Don't over leverage. Know your lot size. Know your lot size, guys. Entry price 188.769. Stop loss 188.453. And then take profit 189. Okay, guys, I have mine placed. We have our pending order on. Okay, as we're waiting for this particular trade, let's look at another pair. Let's look at gold. Then after gold, if we still have time, we can look at GBP USD. Let's look at gold, guys. So you know the drill. Let's head straight to the daily time frame to understand what is going on here. So we are looking at gold from the daily time frame. From the movement, we can obviously say that gold is bullish. We can obviously say that gold is bullish. We got the first record structure here. Then we have another break of structure here. we have another break of structure here, guys. So we can obviously say that gold is bullish. Now, if we are looking to enter trades from the daily time frame, we'll be looking at this. You can see what I'm talking about. We have this consolidation before these impulsive movements. Gold kept on consolidating for a while. Then after that, we got an impulsive movement to the upside, which caused this particular break of structure here. So if we are to join the trend, if we are to join this bullish momentum from the daily time frame, we'll be looking to enter trade if price should come back to this particular zone. We'll be looking to enter our trade from that level. But having in mind that gold is bullish, let's go to our entry time frame to see if we have a setup there. So gold is bullish, so we'll be looking out for possible buy setup. Okay, guys, from the movement we have here on gold, that's from 15 minutes time frame. From what I can see, we have choppy movements, so I don't think there is any setup for us here on gold. But from the higher time frame, just having in mind that gold is bullish, so we just need to patiently wait for the market to, bring out opportunity for us to join the bullish trend. But from what I'm seeing, we have a choppy movement and we don't need to force out entries. Remember, if it's not there, it's not there. So you don't need to force it. There's nothing you can force out here now, guys. So we'll just stay off and just be, looking at gold. Just following my strategy. I don't have any reason to take any action now on gold. So I'll just be looking out for possible, setup that will show up. So if I'm to join what is currently happening, or if I'm to wait for a possible buy entry, I just need to see price clear out this consolidation here, maybe clear it out to the upside, giving me a break of structure. Then any slight retracement, I'll join the buy. So, but for now, there's no reason for me to either buy or sell gold following my strategy. There's no reason for that. So guys, before I end by section, let's look at which pair should we look at again? So let's look at GBP USD to see if we have our setup there. See if we have setup there. Okay. Okay, let's still view what is going on from the higher time frame on GBP USD. Okay, GBP USD daily time frame. I can also say that it is bullish. I can also say it's bullish. That's what we have there. This impulsive movement, and we have this break of structure. So this movement, I can say that it is targeting this level. So from what we can see, it was ranging here for a while, and now we have a break of that particular consolidation. So that is why I am saying GBP USD, on a bullish push. Because if the price is retracing, it can retrace, get to this level, and still take off. So on that note, let's head straight to our entry time frame to look out for possible setups. Okay. The movement here in 15 minutes, it's kind of disappointing. I think we have something. So this particular origin, this particular consolidation here, if we get a push into this zone, we should be looking to buy GBP USD. If we get a push into this zone, we should be looking to buy GBP USD. So looking at this consolidation, if it causes a push to this level, we should be looking to buy GBP USD from here. So, but for now, nothing is ready yet on GBP USD, but let's have this POI in mind. Let's have it in mind. We should be looking to buy from this level if price should retrace here. Well, if price doesn't get to this particular level and we get a break, we get a push to the upside from this level, that simply means we'll now have new origin at this level. We'll still wait for retracement. So whatever you're doing, you just need to follow the strategy and just stick to it. So for me, whenever I'm looking at the charts, this is how I look at the charts. I don't need to, start doing another thing. Just get that strategy that works for you. You stick to it and use it and make money and grow your trading accounts and become profitable in trading without jumping from one strategy to another. At the end of the day, remember both the professional traders, the traders you look up to, all of them, they lose money too. But remember, what makes you a good trader is, you just need to learn to be a good loser. So get a strategy with an edge, have your trading plan, apply proper risk management, and get to accept the reality of trading. And you make trading easy for you. You trade with peace of mind. So guys, another section will be coming up from one of my colleagues too, that is Ambrose Ebuka, and I believe he has a whole lot in stock for you guys. So before we go for a quick break and then introduce him, hope you enjoyed my section. Hope you enjoyed this section. So if you have questions, I can just take just 2 or 3 questions, then we'll go for a break. Hope you enjoyed this section, starting from the first badge to the second badge. So if you have any question at all, you can go ahead and drop that. Okay. So guys, thank you for, paying attention, being active, and, I enjoyed the interaction and the comments. Thank you so much. And see you guys in my next live trading section. So just get ready, take a little rest, and get ready for the next section. I believe it's coming with bomb. So guys, just get ready. Okay. Okay, Christopher, I like the way you teach. You are good at teaching. Thank you very much. I appreciate it. Thank you.
Let me know in the chat if you guys can hear me. Go ahead and let me know in the chat if you can hear me now. All right. We had like a little technical issue that we have just fixed. So I'm just going to go ahead and get right into today's session. And again, welcome everyone to How to Invest with Octa. My name is Ambrose Ebuka. And before I go into the details of today's session, you can go ahead and let me know your name and where you're watching me from. And for you guys that stayed till we got the audio fixed, thank you very much for sticking. And you can use this opportunity to also share the link with your friends and invite them to learn and earn with you. So today, we'll be decoding Forex trends and unraveling market dynamics. You guys have had two incredible sessions from Tunmise and Happiness. I think Tunmise discussed a lot of things that had to do with economic indicators. He talked about macroeconomic indicators and the economy. He also talked about the inverse relations of the current account deficit and the Forex reserves. So if there's anything that you learned from these sessions, these incredible sessions that was just concluded by Tunmise, let me know in the chat as well. And I believe you guys also learned something from Happiness session as well. She talked about how you can trade with the right mindset, that this involves the psychology of trading. She also introduced you guys during her live session, a live trading session, to smart money concepts where you learned a lot about break of structure, change of channel, change of character, and all that. So let me know in the chat what you learned from these previous sessions. Emmy from Umar here. Offensive from South Africa. Apologies if I don't pronounce your name correctly. But you can let me know if I did in the chat. Fair on me from Ilorin. Aisha from Ilorin. Debbie from Nigeria. David from Lagos. Abongile from South Africa. Prince from Kaduna. Welcome every one of you. Again, let me know in the chat what you learned from the previous session. So today we're going to look at some of the market dynamics and how you can decode Forex trends. And why is this topic important? What are you going to learn from it? Now, the objective of today's session is to help you as a trader master the complexities of analyzing the foreign exchange market for strategic decision making. Guys, with trading, it's always going to come down to making strategic decisions instead of rash decisions. Now, I believe that regardless of your trading experience, if you're a beginner, if you're an intermediate trader or an advanced trader, I believe there are times where you come into the charts and you just feel like buying without analyzing. You're probably seeing a candlestick pushing upwards and you're like, let me just join this buy. Or you see a candlestick pushing downwards and you just feel like joining the sell. These are rash decisions, right? So this session is going to help you understand the dynamics of trading and how you can make your decisions, well-informed decisions in the Forex market. I'm going to read the disclaimer quickly, and we can go over the content of today's session. Okay, Stephen George is saying he learned having the right mindset. I believe that was from Happiness' session. You guys should tell me whose session you're learning, you're benefiting from. Having the right mindset. I believe that was from Happiness' session. Stephen George says a lot has been learned. What's a lot? What's a lot? Tell me what you've learned. Okay, disclaimer. Any opinion, news, research, prices, analysis, or other information discussed in this training or linked to this presentation are provided as general market commentary and do not constitute investment advice. Now, this session has been split into 3 sections to help you understand better. We have the first section where we look at the introduction to the Forex market, right? Understanding the dynamics of the Forex market. I talked to you guys about Forex itself, help you understand liquidity, and help you, take advantage of trading sessions that would fit into your schedule so that you can be comfortable while you're trading. In section 2, we're going to look at some of the tools that you can use to make informed decisions. We'll brief the fundamentals. We'll look at the trends, and I'll introduce you guys to a technical framework that can guide you with executing trades. And in the third section, or in the third section, we're going to summarize with a Q&A section. We're going to do some live practice, and I'll just wrap up with an advice for traders. Once again, if you're just joining, welcome. It's the How to Invest with Octa, and yeah, stay tuned and enjoy. Okay, I'm going to look into the chat again and see if we have any more comments on the benefits from the previous sessions. Happiness did justice to psychology aspect of trading. Davis, amazing. Piapo learned how to wait for the right confluences. He says it's key. Prince learned how to have the right mindset and hold your trade from Happiness. Amazing, amazing. It's good to see that you guys are actually, writing things down and taking note of some of the important steps that you're being taught today. Now, we're going to go right into today's training. And again, we'll start from section 1, and I'll introduce you guys to the Forex market and, give you guys a brief of what it's all about before we get into the important part. Now, the foreign exchange market, which is usually known as Forex or FX, is the largest financial market in the world with a $6.6 trillion total daily liquidity. The Forex market is a global decentralized market where the world's currencies change hands and exchange rates change in seconds, so the market is constantly fluctuating. Now, when you hear the word market, what comes into your mind? Your local malls that you have, the ShopRites, even markets like Idumota markets. You guys know the markets that are popular in your area, right? So what comes into your mind when you hear about markets? Buy and sell. Now, when you go into the market, obviously, you're going to take out something because you're going to buy, but you're doing an exchange. You're exchanging money for that item that you're buying. Now, with Forex, it's still a market, but what we trade are currencies, commodities, and digital currencies as well. Now, under currencies, we have some examples like the euro, the pound, the dollar, the Japanese yen, Swiss francs are just a few. We have a lot more other currencies that you can trade in the foreign exchange market. And under commodities, we have gold, silver, oil, and we have also digital currencies that you can take advantage of as well in the foreign exchange market. So that's just a brief introduction to Forex so you can understand what it's all about. I believe that if you're an intermediate trader or even beginner trader, Forex is not really a new thing to people right now. But if you don't know, now you know. We're going to look at understanding liquidity, which is an important aspect of trading that I believe every trader should know. So we have two types of liquidity, right? High liquidity and low liquidity. Now, liquidity itself refers to the levels of market activity and the ease with which traders can execute buy or sell orders without causing significant price movements. Now, again, we have high liquidity and we have low liquidity. Now, high liquidity is a situation where there is a large volume of trading activity and a significant number of buyers and sellers in the market. High volume of trading activity, high amount of buyers and sellers in the market. What this means is that you're going to find it easy to buy and sell. You won't have your trade. And that's why the Forex market is the most liquid financial market in the world, because it's just easy to place buy and sell orders. You have someone on the other end waiting to sell, someone on the other end waiting to buy. So it's a highly liquid market. And that's just what high liquidity is all about. There's a large volume of trading activity and a significant number of buyers and sellers in the market. And how can you identify high liquidity? It's characterized by tight spreads, swift and efficient execution, and price stability. So basically with swift execution, what it means is that let's start with spread. Your spreads are going to be tighter because now buyers and sellers are coming closer. The difference in prices wouldn't be that much anymore. Your trades are going to be executed instantly. Okay, these are some of the characteristics of high liquidity. And some examples would be major currency pairs like Euro USD. I believe that if you've been trading for a while, I mean, even in your first day of trading, you would have come across currency pairs like Euro USD, USD JPY, GBP USD, all this. And you may not know the difference between major currencies that are highly liquid and, maybe exotic currencies or minor currencies and all that. So there are some currencies that exhibit high liquidity. For example, the Euro USD, USD JPY, GBP USD. We also have NZD USD, AUD USD. These are some of the major currencies that exhibit high liquidity, and this is due to their popularity and widespread trading activity. And the second example of a highly liquid market would be a high impact economic release or a major geopolitical event that could temporarily increase liquidity in the Forex market. Now, this is for high liquidity. Remember, we also have low liquidity, which is where there is a limited volume of trading activity and fewer market participants actively buying or selling currencies. Now, let me give you guys a hint with Forex trading. So if you're new to the market and you really, really, really want to understand how Forex really works, what you just do is when you get a theoretical aspect of trading, or you're trying to understand something by reading, you just take what you've read, go to your chart, and apply it on your chart. So, for example, right, we have high liquidity that shows you there's a large amount of or high volume of trading activity going on. Now, you understand that when there's a high volume of trading activity, the market is highly liquid. There's some characteristics with high liquidity. And when you come over to low liquidity, you see that this signifies low or limited volume of trading activity and fewer market participants. Now, you've been, just by reading and applying on your charts, you've been able to, distinguish or differentiate between high liquidity and low liquidity. And another important thing about liquidity is low liquidity, yeah, there are fewer market participants, but you can still make money in a low liquid market. Okay, so let's talk more, or let me just discuss more about low liquidity. Now, it's characterized by wide spreads, slower execution, and increased price volatility. So the spreads are going to be wider, and your trades may not execute as fast as it would if you're trading in a highly liquid market. And you could fall into some challenges like slippage risk. Your trades may not be executed at the exact price that you want to execute your trade at. And that's where depending orders come in. If you were in a Happiness session, you'll recall that she executed a live trade with a pending order, right? That's a future trade. Okay, so if you're trading a low liquid market, and you don't want to fall victim to, or you want to avoid slippage, you can use a pending order. Okay? So that still comes down to you can make money in a high liquid and low liquid market. Excuse me, guys. So second challenge would be limited trading opportunities because of the widespread and slow movement of the market. You may not have enough opportunities to get in and buy or sell an asset. And also the spread that is wide, the spread is your cost for executing a trade. And if you didn't know, whenever you execute a trade and, just place buy or sell and you see your trade reading in minus, like you just execute sale and you're already like minus $1 or $5 or $100, depending on your lot size. That's your cost. That's your spread. Okay. So when the spread is wider, which often happens in a low liquid market, then these transaction costs would be wider as well. So don't mistake the transaction cost for anything else. It's just the spread that we're talking about there. Okay. What are the examples of a low liquid market? Now, low liquid conditions or low liquidity conditions are common during off-peak trading hours when major financial centers are closed, such as late in the evening or early in the morning. Now, let me know in the chat, how many of us have placed trades at night, let's say 10 p.m., 11 p.m. Nigerian time? You place trades and you just see that the market is moving very, very slow. And you don't understand what's going on. You executed trades in the market 10 p.m., 11 p.m. Nigerian time. I think with gold, you may not be able to execute trades with gold by 10 p.m. or 11 p.m., but some other pairs you can. And you just notice that the market is moving really slow. Let me know in the chat, how many of us have experienced that? So these are low liquidity conditions. Give me a second, guys. All right. And another example would be market holidays or period of reduced trading activity due to seasonal factors or geopolitical events. These are all some of the things that can lead to low liquidity in the Forex market. Okay, I see some of you have experienced that. Well, it's not that the market doesn't want you to make money, it's just for you to understand that there is high liquidity, there is low liquidity, and your trade may not move as fast as you want at that time, but it's going to transition. The market transitions from low liquidity to high liquidity to low liquidity and so on. Let me know in the chat if you guys understand how liquidity works in the Forex market. And we're going to go ahead and talk about trading times and sessions. Let me know in the chat if you guys understand how liquidity works in the Forex market. And if you have questions, keep your questions. I would answer your questions when we get to the section for Q&A. And I'd also ask you guys questions. So it's very important that you stick around and pay close attention. Okay, currencies are traded 24 hours a day, 5 days a week around the world. That's for the Forex market. And it's important that you understand trading times and sessions because a lot of us have different things that we do, right? Some of us work in 9 to 5, some of us have a tight schedule. But with trading times and session, you'll be able to come into the market and still place trades at a comfortable time that works for you. Now, we have 4 major trading sessions in the market. We have the Sydney session, the Tokyo, the London, and the New York session. And one important thing to note about these sessions is that they last for 9 hours. And this detail that you see here is in Nigerian time. So you can write this down or take a screenshot of it and always memorize it. Okay. So you can see that, let's say, for example, if you work in 9 to 5 and you get back home 6, 7, 8, 9 o'clock, you can trade the Sydney session. 1 a.m. you can trade the Tokyo session. And what does that mean? It means that the currencies that are paired with the Japanese yen would be active at that time. You can still trade those pairs. 8 a.m. you can trade the London session. 2 p.m. you can trade the New York session. Now, most times when both sessions overlap, it could bring about a huge amount of volatility, which is also something that you can capitalize on as well. But one of the importance of understanding trading times and sessions is so that you can fix your trades or a trading schedule or activity around this session. So you don't say, well, the market is open 8 a.m. to 5 p.m. So by 10, I can't trade anymore. No, you can't trade. You can trade the Sydney session. You can trade the Tokyo session. You can even use pending orders ahead of that session as well. So make sure you capitalize on trading times and sessions. And I have some keynotes for you guys. I have some important things I want you guys to know about trading times and sessions. Steven says he doesn't really understand. You can let me know what you don't understand in the chat, and I'll explain that when we get to the Q&A session, okay? So, first keynote. Other than the weekends, there are just 2 public holidays when the Forex market is closed: Christmas and New Year's Day. Opening and closing times, which is the second keynote. Opening and closing times are based on local business hours, with most business hours starting somewhere between 7 to 9 a.m. local time. The Forex market's opening and closing hours will change in March, April, October, and November as countries move to daylight savings. I think we experienced that in March. The clocks move 1 hour further and 1 hour backward as well. And one important thing you need to know is that Japan doesn't observe daylight saving. And the final daylight savings. And the final keynote would be that it's important to trade at least when 2 sessions are open because market tends to be volatile at that time. So these are some of the important keynotes that you need to understand as you take advantage of trading times and sessions in the Forex market. Now, I believe that if you were here in the previous sessions, by now you should have already taken advantage of this promo code. But if you're just joining us, and if you haven't, remember that you can double your deposit with the promo code HOW2OCTA, capital letters, HOW2OCTA. And how can you do this? You log into your profile, your personal area, in the Octa trading app on our site, octaafrica.net. And you can find the promo code section in the side menu. You enter the promo code and tap activate. You initiate a new deposit and claim your 100% bonus in the checkbox. Complete the deposit process and trade with a booster. Now, another way you can do this is while you're making a deposit, you'll see an option where you can impute or type in a promo code, and you can put in how to Octa. That's the promo code that will give you a 100% bonus to your deposits. Now, remember that to be able to claim these bonuses, you have to trade a certain volume, and it's going to be indicated there as well, the amount or the volume that you need to trade to be able to claim to withdraw your bonuses. Okay. All right. So we're going to look at section 2, where we talk about fundamental analysis. Like I said, introduce you guys to some of the tools that you can use to trade and potentially make profits in the market, and also stay and up your trading game in the Forex market. We have trends, we have technical framework as well, which involves some of the technical tools and steps that you need to put in place to make potential profit in the market. So let's look at fundamental analysis, right? Just a brief intro to fundamental analysis. In simple words, fundamental analysis involves trading the news. Now, this is the way of looking at the Forex market by analyzing the social, the economic, and the political forces that may affect currency prices. We have elections, we have economic stability, inflation, all that. We're going to discuss this as we understand fundamental analysis. And all this just consists of trading the news, or all this make up fundamental analysis. So when you hear about fundamental analysis, or you hear someone say, I'm a fundamental trader, you just have to understand that they get their understanding and their bias from the economic aspect of different countries, and they implement that to their charts and execute trades. Now we have a place where you can get Forex news website. It's going to be octaafrica.net. I'm going to share my screen and show you guys what it looks like quickly. Okay, so when you go to the octaafrica.net, you come down to analysis and education. And if you're using your phone, you just have to go under analytics and you click economic calendar. Now you can take great advantage of this calendar. I'm going to go to the week, and you can see that there are a lot of reports here, and Octa goes as far as showing you the currencies that will be affected or that will be influenced by these reports. You can see the previous, the forecast, the actual. You can see the impact this report would bring in the Forex market. Now, mine is set to high because I just like to focus on the high impact events. As the name goes, it brings about high volatility to the market. So that's what I want to pay attention to. But if you're a beginner trader, click advanced filters and include medium and low impact for the knowledge. And you can see that's going to be updated, and you can basically read these reports, understand, the stance, the monetary policy stance of different central bank governors, because this would also have an effect on the domestic currency of that country. Okay, so we're going to go right back into the session. Just wanted to show you guys what the economic calendar looks like, and briefly how you can take advantage of it. Now, under fundamentals, which is economic trading the news, understanding how the news impacts the currency markets, we have 8 major central banks. You can also write this down or take a screenshot of this. We have 8 major central banks. We have the Australian Reserve, which is the Bank of Australia, Reserve Bank of Australia. We have the Bank of Canada, the ECB, the European Central Bank. Also important that you take note of the abbreviations, because when you read some articles or you get this market analytics or insights from Octa to your Octa trading app, you could see abbreviations like BOJ. So very important that you take note of this, so that when you see BOJ, you know that they're talking about the Bank of Japan. We also have RBNZ, the Reserve Bank of New Zealand, Swiss National Bank, the Bank of England, and the Federal Reserve System, which is the central bank of the United States. Okay, so these are 8 major central banks. And what you need to understand about these central banks is that their actions and their policies have an effect on the financial markets. They influence everything from the interest rates to asset prices to investor to market sentiment. If you're looking at monetary policies, central banks are the ones that set the interest rates and control the money supply. They provide liquidity to financial markets, sometimes to prevent systemic crisis. If you're looking at control of inflation, the central banks also try to keep inflation stable, and this is also going to affect, traders' expectations and market behavior in general. So these are some of the objectives or the goals of the central banks. These are some of the things that they do. Also regulations as well. The central banks are the ones that regulate financial institutions, and they do this to ensure stability and prevent excessive risk taking. So take note of these 8 major central banks. Very important that you also pay attention to the speeches from the governor of these central banks or the board members as well, because they are important. They provide insights to the future monetary policy decisions, and also they can guide your decision making, help you understand the direction of the forex market. Now, still under fundamental analysis, we have major reports or major key events in the forex market. I believe if you were in Happiness's session, you would have, and also Tunmise's session, because he talked about GDP as well, you'd have gotten, a grasp or an introduction to NFP and GDP. I'm just going to brief on that as well, because we're talking about fundamentals right now. So NFP is a part of a monthly report that represents how many people are employed in the United States in manufacturing, construction, and goods companies. We have GDP, which is the total value of the goods and services produced in the country over a specified period. Now, the GDP, which is gross domestic product, the NFP is non-farm payroll, right? So the GDP does not include sales of goods, illegal activities, black markets, non-monetary compensated work, and unpaid work, which is, voluntary work. We have CPI, Consumer Price Index, which is an index that is released by the US Bureau of Labor Statistics. And this measures the change in price of a representative basket of goods and services like food, energy, housing, clothing, transportation, medical care, and education. Now, we also call the CPI, which is the Consumer Price Index, we call it the Retail Price Index or Cost of Living Index. And finally, we have the Fed, like I said, the Central Bank of the United States, the Federal Reserve System, or the Fed. I have to go back. Okay. The Federal Reserve System, or the Fed, simply the Fed, is the central bank of the United States. It was created by the United States Congress in 1913 to provide the US with a safer and stable monetary and financial system. Again, very important when you're looking at these central banks, it's very important that you understand that they have a profound effect on different financial markets. And these are all some of the events that you can find in the economic calendar. And these events are important because they provide, or they give you as a trader, crucial information about the health and direction of the economy. They influence market sentiments. They influence trading decisions. You can view a potential 3,000 pip move on an asset just because you understood the decisions made by the central bank of a country. That's how good it is to pay attention to economic events and fundamental analysis as well. So as a trader, how can you use fundamental analysis in trading? How do you trade the news? First, you want to look out for the events of the week and the day, and your focus should be on high impact events. Okay, so like I said, use the economic calendar, the Octa economic calendar, and you look out for the events of that day or of that week, because you have to be prepared for the events of the week. And even if you are aware of the events of the week, every day when you wake up and you want to trade, you need to check, right? You need to know what's going to happen that day. Focus should be on high impact events. Again, if you're a beginner trader, look at medium impact as well. You can look at low impact for knowledge, but the low impacts don't really move the market. Now, you have to confirm the time that the news would be released, and you have to understand the meaning of the event and the possible outcome. when you understand the event, if you use the Octa economic calendar, each report, once you click it, there is a definition of that report. Octa provides a definition and tells you, this is what this event is all about. This is what's going to happen if the event comes out positive or negative. It can be positive or negative to the currency. This is what it means. You have to also take note of that while you're trying to understand trading the news. Take note of previous and forecast. Now, if you look at the Octa economic calendar, you also notice that there are reports, their previous reports are showing the forecast, which are investors and economists forecast for that particular report. Now, when you see a reading like actual greater than forecast is good for the currency, you should also look at actual being greater than previous. Okay, so when you're trying to understand how to trade the news, you use all the reports, the previous, the forecast, and the actual. And the sixth or the fifth step, would be to wait for the news release. Now, I know that news event or these economic events can come with a huge amount of volatility, and sometimes you just want to capitalize on that. That's fine. That's okay. There are strategies for that. But you'll be more comfortable if you wait for the news to be released and you can now see the direction of the market. If you recall what happened with gold, with the NFP, right? You saw how volatile the market was, went up, went down, went up again. So if you were patient enough, you'd have waited for the market to make that wild move and you brace yourself up for the bullish run. Finally, and very important, combine with technical analysis and strategies. It's not ideal to trade fundamental or to trade economic events in isolation. It's not ideal to just look at the calendar and say, well, NFP today came out bad. There were more unemployed people than last month, so this is going to affect the dollar. I'm just going to go to my chart and start selling the dollar. No, you want to combine with technical analysis, which you're going to use while we're trading live. So if you haven't already, take note of this, how to use fundamental analysis in trading. Take note of it. It's going to help you understand fundamental analysis better and also improve your trading abilities. All right, we're going to look at the trends so you guys can understand. Trends also apply with technical and fundamentals as well. And we're going to look at the trends so you can understand the movements of the market. When we go to the live trading session and I start to analyze on my charts, I'm going to use some of these strategies. And it's important, again, that you pay attention so that as I'm analyzing, you flow, okay? You understand. Now, we have two types of trends. We have the bulls, we have the bears, which is uptrend and downtrend. Now, if you have ever seen a bull attack, you notice that they attack with their hands from down and they just lift you up, right? Not you, but anybody or anything they're attacking, right? Down to up. That's how the bull market goes, from down and then it trends to the top side. The bears attack downwards, from up to down. So when you hear bull, bear, what comes into your mind? Up, down, uptrend, and downtrend, okay? Now, what is a trend? A trending market is one where price is generally moving in one direction. It can be an uptrend, it can be a downtrend. Now, trends are usually noted by higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. I'm going to give you guys a visual example or representation of what I'm trying to talk about. Okay, now if you look at this image here, you'll see that it's an uptrend, right? And why is it an uptrend? It's a bullish trend that contains a series of higher highs and higher lows. The prices are moving up. Higher highs here, higher lows down. This high that you can see here, I don't know if you guys can see that, but this high you can see here where my cursor is higher than this previous high. So we're going to call that a higher high. This low we can see here is higher than this previous low. So we're going to call that a higher low. And then we have the next one, higher high, higher low. And if it continues to go like that, creates more higher highs and higher lows, then you obviously know that you're in an uptrend. Now, if you want to take advantage of an uptrend, you don't buy high, you buy when the market has retraced and shown bullish identifications or bullish confirmations at the support line. Remember, that the support line connects at least two lows and limits the price from breaking to the downside. If it successfully breaks and we don't see trade above that line anymore, then you'll be bracing up for trend weakness or reversal. For a downtrend, the downtrend is a bearish trend that contains a series of lower lows and lower highs. We have lower lows, lower highs. This low right here is lower than this previous low, so we're going to call that a lower low. This low up here is higher than this previous low. We're going to call that a lower high. Lower low, lower high. Lower low, and we're going to keep going down. So if the market continues to create a series of lower lows and lower highs, lower lows and lower highs, and you see that the market is unable to break above this resistance line that has been connected on at least two highs, limiting the upside, then we know that we are on a downtrend, right? If it's unable to break above it and you see the market trading below this resistance line, we're on a downtrend. If you see a successful break and the market doesn't come back to trade below the line, then you can be bracing up for trend reversal or trend weakness. So that was a brief introduction on uptrend and downtrend, and I believe that you guys also caught the tips and also understood exactly how to spot these trends in the Forex market. Right about now, I'm going to go ahead and show you guys the technical framework, which is what I like to call steps to trade in. It's just you know, the things that you need to do before you execute a trade. I know that a lot of times you guys, well, beginner traders, all level traders actually, because so even at an advanced level, a trader can still make a mistake, right? So sometimes you just have this rush and you feel like, I have to trade today, I have to trade today, I have to place a buy or sell today. And you just come into the market and start to gamble your way through placing buy and sells. That's not good. If you have a step to trading, if you have a framework, it's going to eliminate all that. Now, these are the steps. First thing you need to do is to check the economic calendar. Very important, very important. You need to understand what's going on economically so that you don't draw out a beautiful analysis, a very beautiful one. You have your setups in place. The market is giving you confirmations. You place your buy, and then the chair of the Federal Reserve, Jerome Powell, just comes and says, good morning, and boom, the market goes against you. You don't want to be a victim of that, right? So what do you need to do? Check the economic calendar, understand the events that will be coming out that day, prepare for it. If you have to close trades, close. If you have to set stop loss and break even, it's just important that you're aware that a news is going to come out, so you prepare for it, right? Second thing you want to do is to understand the market structure. You want to come into the market and be able to spot a trend or a consolidation. You don't just come into the market and you're like, well, I'm seeing 3 green candles today, which means I'm going to buy. That's not really how it works. You want to be able to perceive the market, get an idea of the potential direction, right? Yes, you can see an uptrend, but what do you think is going to happen after that? It's going to continue, it's going to go down. Get an idea of the structure, and how can you do that? By using key levels. We're going to use this framework in the live trading session. So you guys are going to see it play out beautifully. Identify your key levels, and you can do that with your support and resistance levels, supply and demand levels as well. You want to also predetermine entry and exit points, right? You need to identify where you want to enter this trade and your exit point. The exit is very important. It's as important as the entry. A lot of times we place trades and we don't even know where we want to exit the trade. We just want to place the trade, use a big lot size, and we allow the amount we make to determine when we're going to close the trade. Guys, you don't want to keep doing that, because what happens if the market goes against you and then you start to pray? So you want to determine or predetermine your entry and exit points before executing this trade. And finally, you want to apply proper risk management techniques. Stop loss, conservative lot size, very important. Adequate risk to reward ratio, right? What do I mean by that? Risking 5% to get 1% is not adequate at all. There is nothing adequate about a 5% risk and a 1% reward. So don't do that. Apply proper risk management. Use a stop loss so that you don't start to pray. You know how you guys do when trade's going against you. You start to hope. Hope is not a strategy. Hope is never a strategy. The market is not going to turn its way because Stephen Judge placed the trade and he's running at a loss. No, the market is not going to do that. And yeah, so these are the 6 or 5 steps to trading, which we're going to use when we get into the live session. And right about now, I'm going to go on a break. And when we come back, we're going to come back to section 3, where we'll do the Q&A. I'm going to ask you guys some questions, and you guys are going to ask me some questions. First, you guys are going to ask me some questions, right? And I'll ask you guys my questions. If you have questions, I understand, it's fine. You can just write it down somewhere. When I get back after the break, I'll start with answering your questions, and I'll ask you guys mine. We're going to do a quiz, and it's very important that you answer correctly. I'll give you guys the rules when I get back in the third section after the break. We'll do a live session, and I'll wrap up with an advice for traders. But that's not going to be the end. So we're all going to come back and talk to you guys. But for now, it's bye, and I'll see you guys in the last section. All right, guys. Before I go on to the Q&A session, let me know in the chat if you guys can hear me clearly. Go ahead and let me know in the chat if you can hear me clearly. Okay, can you hear me? Okay, great. So I'm gonna use 5 minutes to take a few questions, and I'll go on to ask you guys my question, the quiz, and I'll inform you guys about the rules for this quiz. But first, let's take some of your questions. So this one is from Orumoluyi, if I got your name correctly. I usually trade without stop loss and take profit. Is that advisable? Well, it depends on your level of trading experience, actually. I know some traders that trade without stop loss and take profit, but they're not beginner traders. Okay, so I know oftentimes you come online and you see some things online, and it's like, okay, let me just try this and do it and see if it can work for me. Guys, there should be a level of experience to whatever it is you try in the Forex market. As a beginner trader, you could make a profit without using stop loss and take profit. You know, the market could go down and just draw down and go back into profit. That's fine. But it's going to catch up with you at some point. That's what I think. So I think it's important as a beginner trader, you cultivate the habit of minimal risk. That's why the stop loss tool is essential. So that's my take on your questions. Michael is asking, what's the difference between buy limit, buy stop, and buy stop limit? Okay, so buy limit is where, and these are different pending orders. So buy limit is where you want to place a buy trade, and you're placing the buy trade below the market price, right? So you want the market, for example, the market is at 450 something, right? Now your entry price is going to be below like maybe 445, 440, in anticipation that the price is going to go down, activate that buy, and if it goes up, you're in profit, okay? Then buy stop is where you want the market to, you're placing a pending order above the market price. So let me give you an example again. The market is showing 450 for an asset, whatever asset is this, just an example. And you want to buy that asset, but you wanted to get to 470 first before you buy. You place a pending order above 450 is the market price. You're placing your pending order 470 and you're saying, I want this market to get to 470. If it gets to 470, the automatic order, which is the pending order, the buy stop, will be executed. So buy limit, you're placing below, buy stop, you're placing above. I'm going to take one more question and we can go to the quiz. Stephen George is asking, if you have a tight schedule, can you place trades after all analysis has been done and don't have to monitor the trade anymore? Yes, you can. You can do that with pending order, and your pending order would include stop loss and take profit. And what does that mean? It means that you've placed an order for the future, right? Whenever price gets to that order, it executes. You've placed an automatic stop loss and take profit. If it goes against you, your broker halts the trade from going further down into loss. If it goes in your direction, your broker secures a profit with the take profit order. So you've just placed an automatic order on a trade and you can go about your life. You can, go watch a movie, watch football, go out on a date, whatever you do. So that's it. I believe that when we get back, myself, Tunmise, and Happiness will be able to answer all of your questions. But right now, I'm going to go over the Q&A session, which is my quiz session. And let me know in the chat if you guys are ready for this Q&A session. For this quiz, let me know in the chat if you guys are ready, and we'll get right into it. Okay, let's get right into it. So the first question, and remember the rules, right? The rules is that you can type your answers, right? But you have to type it. So these are 4 questions, and you can type all four answers at once. Okay, so for example, if number one is F, number two is J, number three is Z or Z, you have to type your answers F, number one, F, number two, this, number three, this, number four, this, and send at once, right? You don't send it one by one. You don't send it singular. You type all of them and send once. One, F, Z, X, whatever. Okay, you don't just say one S, one this, two this. No, don't do it like that. You send everything at once. If you were here in Happiness session, just exactly how you did it in that session, we're going to do it. And if you're new, remember you send your answers in bulk. You don't send it one by one. Now, the first question is, what are the types of liquidity? A, hold and long liquidity. B, high and low liquidity. C, hot and cold liquidity. And I didn't say this earlier, but good luck to all of you. The second question is, the Bank of Australia is abbreviated by A, BOA, B, BAA, C, RBA. The Bank of Australia is abbreviated by A, BOA, B, BAA, C, RBA. Third question. The uptrend is made up of what? A, lower highs and higher lows. B, higher highs and lower lows. C, higher highs and higher lows. What is an uptrend made up of? Remember, single answer, okay, it's already there in the chart. Single answers will not be eligible. You have to answer all at once. Put your options or your answers for the questions and send it in at once. What is an uptrend made up of? Lower highs and higher lows, higher highs and lower lows, higher highs and higher lows. And the final question, which is the fourth question, is, in the framework that we discussed today, what comes after checking the economic calendar? In the steps to trading, I'll just give you guys a hint. What comes after checking the economic calendar? Identify entry and exits, understand market structure, or identify key levels. Now you have the four questions. You can go ahead and type your four questions in the chat right now before I go on to review the answers. Type your four questions in the chat right now before I go on to review the answers. All right, we're seeing the answers coming in. I'm going to give that a minute and we'll go over the answers of the quiz. Okay. Good luck to you guys. I'm good over the answers right now. I believe that you guys are paying attention because at the end of the day, right or wrong, you have something you need to learn today, right? You've got to learn. Okay, let's get on and see the answers. The first question was, what are the types of liquidity, right? What are the types of liquidity? We had three options and the correct answer was option B, high and low liquidity. So if you got that correctly, congratulations. If you didn't, well, you've learned something today, so keep that in mind. Second question was, the Bank of Australia is abbreviated by what? Again, three options, A, B, C, and the correct answer is option C, RBA, Reserve Bank of Australia. If you got that correctly, congratulations as usual. And if you didn't get that correctly, well, again, you've learned something today. The third question was, the uptrend is made up of A, B, C, three options, and only one can be correct. And the correct answer is option B, higher highs and higher lows. And the final question was, in the framework we discussed steps to trading, what comes after checking the economic calendar? 3 options, and the correct answer to number 4 was option B, understand market structure. Congratulations if you got it correctly. Congratulations to you. If you didn't, you've learned something today. Remember that there can only be one winner, and I believe we have the winner in the chat already. Deborah Ruth. Congratulations. You're the first to give correct answers to 4 questions, and you can follow the steps that's from the moderator in the chat. Follow the steps that's been provided there and provide your details so you can get your prize. Congratulations to you and to everyone else that participated. Congratulations. We are going to go over the live trading session where I show you guys my chart, and I believe you guys are ready. Let me know in the chat if you're ready. Remember that you can double your deposits with the promo code HOWTO-OCTA, and you can do this by logging into your profile with the Octa trading app on our site, octaafrica.net. And you can find the promo code section in the side menu, put in the promo code and tap activate, and you initiate a new deposit and claim your 100% bonus in the checkbox. Remember that you need to complete the deposit process and trade with a booster. 100% bonus, take advantage of it, and yeah, successful trading. So I'm going to go over my charts right now and share my screen. Only one person is ready for the live trading session. Are you guys sad? Come on now. All of you that participated in the quiz and didn't win, you've got congratulations from me. And also you're going to get, insights that you would use to trade and potentially make a profit. So if you're ready, let me know in the chat, guys. All right. So what we're looking at right now is the chart for the dollar index. And you'd wonder, why am I on the dollar index chart? So very important. Most of the currencies I trade are major currencies, right? GBP USD, Euro USD, gold. And these currencies are paired with the dollar, which means I have to look at what's going on with the dollar, and that can also give me extra guidance, right? Now, one way to do that would be to go to the monthly time frame of the dollar. I'm going to zoom in a little bit. Go to the monthly time frame of the dollar. And what can you see? You can see that this month, the dollar is bearish, right? It's trading downwards. You can see that for February, January, we're bullish. What happened? We hit resistance, boom, started to trade to the downside. And if I zoom in closer, you'll see some key levels that I have mapped out from the daily time frame, right? Let's go to the daily. So the idea is to look at the markets from the monthly, the higher time frames. You go even lower to the monthly time frame, to the daily time frame. So you start from the monthly, you go to the daily and the 4-hour time frame. And what you want the market to do is to align together, right? So if the monthly time frame is bullish, daily is bullish, you want the 4-hour to make some pullbacks so you can position yourself for another bullish run, right? Now, if you look at the dollar index, you would see that we have indicated key levels. And what do you notice with key levels? The most obvious thing with key levels is the market tends to retest those levels. The market moves like a magnet, right? So you look to the right, you plot your levels, look to the left, and what do you see? Retest, 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 retest here, retest here, retest, retest. So you see how the market is just retesting these zones. We have another retest here. All these key levels have been retested, and there is a potential for the market to make multiple retests on its way down or on its way up. For example, right, as we've identified these key levels here, you see that what's the market trying to do? It's reacting to this one, And why is it reacting to this one? This is a strong key level that we can trace all the way back to June 2023, right? You see the breakouts, you see the, I would like to call this a consolidation. If I go to the lower time frames, you see that there was a pullback here, but the market just reacted to this key level before it broke out. We have it here, retest, pullback, another retest, pullback. We have another retest here, still on the same level. We have another retest here, the breakout, the retest, another retest, and now we have another retest. So you see why this is an important key level in the Forex market, in the dollar index. What is the market trying to do? It's trying to break below because the dollar is pretty bullish at the moment. And you see that the market is trying to break below. And if this market wants to get to this level, let me push this to the top. Give me a second, guys. Okay. So if this market is to get to this level, let's say this, what do you think is going to happen first? It's going to first make a retest at this area of support, break below it before it comes down to retest this level as well. Except there is a major news event that just gives it a spike. Otherwise, what you're going to see is retest, consolidation, breakout to the downside, or a pullback to the top side. And that's exactly what we're going to see here, right? We're going to see this consolidation and a potential breakout to the downside. And obviously, if you get a nice break to the downside, we're coming down to rest at this support level. If we're not able to break below, then we're going to be trading above this newly formed support level as well. But right now, the dollar is bullish. You can see it clearly, and you can see that it's striving and trying to break below and push even further downwards. Okay, you can trade the dollar index. This is a single. You can really, it's not paired with any currency, as you can see right now. So we're going to go to a currency, an actual currency pair, like the GBP USD, and use the bias we have from the dollar, and also use the technical framework, steps to trading, and see the levels that we can identify, and also try to identify areas where we can take up trades in the pound dollar market. All right. So if you look at the pound dollar, you see that I have already identified some key levels here. Let's zoom this in. So I've already identified some key levels here. You can see we'll start from the bottom, which is the most obvious. The significant support level that we have here at this zone, 1.2050. And we're going to take it step by step and go all the way to the top, or explain these key levels and why they are important. And we'll now look at the potential future direction for the pound dollar. All right. What do we have here? We have a double bottom, clearly. A double bottom pattern. We have the breakout of the neckline you can see here, and also the breakout of the 200 period moving average. I saw someone ask in the comments if indicators are good, if you're supposed to use indicators. I think this was in Happiness's session. I guess indicators are like an added confirmation to your trades. Okay, so for example, when I see a trade, when I see the market make a retest at this trend line, you can see that we drew this trend line, got it above the highs of these candlesticks, and you can see the market came to retest. Just like I said, the market tends to move like a magnet. And what do you call this type of trading? It's called zone trading. You're trading the zones. Okay. Now you see the market break above this resistance level, minor resistance. You can see the major resistance here, broke above it. Now this resistance level aligns, as you can see here, this resistance level aligns with the 200 period moving average. Two key levels. We have the resistance, we have the 200 period moving average. The market successfully broke above that resistance and the 200 period moving average. And what do we have? We have a retest. The doji candlestick indicating indecision, telling you that, look, the bears took over, yeah, but they're not able to continue to the downside. So what do we have? Indecision, the bulls took over again. Boom. That's confirmation. We have the breakout from this key level, breakout of this key level. We have the buyers taking over from the breakout. static confirmation to go long. If you want to wait for extra confirmation, this is another resistance level here. Break out and retest again and continue to the top side if you want to add more trades. So that's just the power of zone trading, the power of identifying your key levels and making sure that you wait for the market to get to those key levels and trade the reaction of the market. Let's say if we look here, let's look here. So we have this, I'm just going to make it very bold a bit for today. So we have this resistance line that we've drawn above the highs of these candlesticks, right? These are trend line. Now you can see that for every time the market got to this trend line, what happened? It pushed back down. You can see it here. Down, retest, push back down, retest, push back down again, retest, broke out to the downside, right? So you can see the power of utilizing key levels, because obviously the trend line resistance there has served as a key level. We also have the resistance from the horizontal line there as well. These are multiple confluences. We're seeing the rejections, massive rejections happening a couple of times. And levels, looking at how the market reacted, you could potentially make a profit. Okay, so I just wanted to point out for you guys the power of key levels, why it's important to utilize key levels in your trading. You can also see it here. Bounce, 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 multiple bounces here. This just created a consolidation, and if you traded the reaction of this market at every support and resistance, you'd have also made a profit. You can see here as well, we have this support trend line drawn below. You can see here, support trend line has been drawn below. You can see the bounce, bounce, and another bounce. Now with this market, let me give you guys, so you can see how we moved from historical market or historical price data. You can see here, we moved from here, we analyze this market all the way to the top, and now we are at the current price action, right? Now you can see we have this support trend line that we've drawn here, right? We've seen that the market was hindered. The bears were stopped from breaking below this trend line. Now, if we had a break below this trend line, another break below this 200 period moving average and this key level we have here, we would be bracing up for a massive sell on pound dollar. But we didn't get that. The bears were rejected multiple times. 1, 2, 3, 4, 5. Almost got down, but didn't. So we're not going to count that. 6 times. This makes this trend line, this support trend line, a very strong support trend line, which I'm obviously going to extend, because now we have levels like this on the side. We also have levels like this I'm going to extend as well, which is where market is currently trading out. You can see the power of key levels, guys. You can literally see it playing out on your screen right now. Okay, so you can see how we just extended this resistance from here. We can see the market breakout, came back to make a retest. It's dancing around. Is it going to continue to the top? Is it going to trade to the downside? And with key levels, very important, you wait for the market to act and then you react. So what do I mean by that? I'm looking at this market right now. It's on the daily time frame. If you're not aware, this is on the daily time frame. And what that basically means is that every candlestick here opened and closed within 1 day. Each candlestick here means a day price data. It gives you the data of what happened in a day. So if this is bearish, the blue is bearish, the white is bullish. I just don't, like to use the green and red. But the white is bullish, the blue is bearish, and you can see that day before yesterday, the market was bearish. Yesterday was bearish. Today, we're seeing kind of a doji candlestick, right? But I just wanted to explain that for you guys. But currently, what are we seeing? We're seeing the market react to this key level. Now, it wouldn't be ideal for me to just go into this market and say, well, we're having a retest, I want to buy, because I have a zone waiting for me up here. And this zone, I can trace this zone all the way back to the monthly time frame. I'm going to show you guys right now. Boom. You guys can see this is a previous yearly high on the pound dollar. And there's what we call the weak fill strategy. What that basically means is that when you have a long wick like this, there is a potential for this market to trade all the way to the top to fill up at least half of this wick. At least half. We saw it happen with gold. I don't know if I have enough time to check gold, but I'll show you guys how the weak fill strategy played out in gold. And we're going to potentially see it happen right here in pound dollar. There is a potential for this market to trade all the way up and trade even above half of this wick that you can see here. But I'm not just going to, because of that strategy, start to buy when I haven't seen any confirmation. Now you guys can see how we use the steps, right? We went from the monthly time frame, we came down to the daily time frame to understand the direction of the market. The monthly gave us an overall view. With the daily, we're seeing the direction of the market. We're seeing how the market is reacting to these key levels, as you guys can see, right? Now, the monthly has given us potential target points for the pound dollar. We're seeing how many pips potential move. Let's see. About 350 pips potential move in give me a second, guys. Yeah, about 350, as you can see, in pound dollar. But I need confirmation, and that's where the entry and exit comes in. You've identified your key levels. Now you need to identify your entry point. And what we're going to do is to go even lower to the 4-hour time frame. And as you guys can see, this is the reaction we have on this key level. Breakout, we've seen the market pull back. Now, if I zoom in, you'd see that the buyers are not really giving me enough momentum here. We're seeing the candlesticks of the buyers are not showing me momentum. As you can see, we're not seeing huge momentum, just like this type of candlesticks that you can see here that indicates bullish momentum. This one as well. We're seeing more of bearish momentum than bullish. It's almost as if the buyers are struggling to break above this level. Now, you see that because I went even lower, I'm able to spot the current candlestick, which is looking, or it hasn't formed completely, or if it closes like this, it's going to be a shooting star candlestick. We already have a doji. This is just signifying that the buyers are not really active and strong at this point. Is it going to continue like this? We'll have to observe and find out. This is a key level. We want to see the market break either below or above. We're not going to rush in and start trading a consolidation. We're not going to rush in and start trading a uncertain market. Okay? But the potential for pound dollar is still bullish. I'm going to identify another level where I expect this market to retest, which is going to be this level. I'll indicate that for you guys as well. All right. So I need the market to successfully break above this level, and I can start to look for more buy opportunities if we get a break above this level. Otherwise, I expect if we see a retest here and a pullback, then we're going to come down to make multiple retests at this key level and potentially this one that would align with the 200 period moving average, just like this. So you could see this, and then boom, to the downside, rally, bounce off before we continue to the top. Okay, so very important with key levels. You want to be sure. You want to wait and see how the market reacts. And the only way to understand how the market would react to a key level is if you're patient enough for the market to play out. Okay, so let me know if you guys understand in the chart how to trade key levels and how to use the technical framework. Let me know in the chat. Let me know in the chat if you understand the technical framework. How did you set the 200 period moving average? If you're using your mobile phone, then you just go to the chart of whatever asset it is. At the top, you'll see an F symbol. F symbol. You click on that, you click on moving average, you set the period to 200. Okay, that's the 200 period moving average. That's how you set it. That's how you set it. And if you're using your mobile, you can always insert it from here. If you're using your web terminal, rather, you can click on Insert Indicators. You can come down here to Trend. Come down here and you can see the moving average indicator. I think that question was from Michael. So let me know if you understand now how to use the 200 period moving average, how to set it up on your mobile and your web terminal, your Octa web terminal as well. So guys, if you look here, you'll see what I was talking about on gold with the wick fill strategy. You can see it here. The market created a long wick here, and this was created in December 2023. And what happened? The market came up to even break above it, right? Came up to break above it. So with the wick fill strategy, what it basically means is that when you see a long wick created like this on the higher time frames, guys, very important. We're looking at the higher time frames like the daily, the weekly, and the monthly. Those are the time frames that this strategy, the wick fill strategy, would be more important to spot. When you see a long wick like this, there's a potential for the market to trade and trend. This could take a while, but there's a potential for the market to fill up at least 50% of this wick before it comes down or even break above it. But with gold, you can see that we broke above and we're still bullish on gold for the meantime. Even though looking at overbought, looking at the RSI on gold, we're at overbought levels of 75. We're still bullish on gold. The thing with trading a trend is you have to wait for the trend to bend. You have to wait to see a pattern that shows you this trend is about to bend. Obviously, this is not going to last on the overbought levels. So we're going to see some pullback or some push to the downside. But if you trade the RSI in isolation and you only want to sell when the market is, overbought, you want to sell, oversold, you want to buy, just like that without combining with technical analysis, you may find it difficult to understand how it works with RSI. So you want to combine your RSI with technical analysis, right? Not just say, oh, we are overbought, let me sell, we're oversold, let me buy. All right, guys, let's see if we have any questions. Let's see if we have any questions in the chat. And also, guys, if you've learned something today from this session, you can go ahead and let me know what it is you've learned. I just figured out that there wouldn't be another session today for me to ask you what you've learned from my session. So you can use this opportunity to let me know in the chat what it is you learned today from my session. So it's called the wick fill strategy. I think Michael is asking, what did you call the name of the strategy? It's WICK FILL. That's wick fill. To fill water, right? week fill, to fill the week, 50%. When is the best time to do your analysis? Every time is the best time, but if you're talking about time frames, we just did it right now. We went to the higher time frames and went from higher to lower to identify areas where we can join the trend on the higher time frames. Now, I'm not saying you can't trade against the higher time frames, but you need to be aware of what you're doing. If the higher time frames like the monthly and the daily and the weekly are saying up and you want to go down, you need to be aware that, look, you're trading against the trend and this is going to be a short-term reversal, right? So I hope I answered your question. You can adopt this method on all time frames, but it's just, the lower time frames have a lot of noise. There's a lot of noise in the lower time frames. That's why I like to stick to the higher time frames. All right, guys, I see that you guys spotted something with the question, with the answer for this question. The uptrend is made up of lower high, higher lows, higher highs, lower lows, higher highs, and higher lows. And the correct answer is option C, just for clarity, higher highs and higher lows. That's the correct answer, guys. And I think we have a new winner, P Apple. Congratulations, P Apple. You've been asked to provide your trading account number and your full name as well. Congratulations. And congratulations to every one of you that spotted out this. It really shows that you guys are paying good attention to what you're being taught, and very impressive. When I wake up in the morning, the first thing about trading is to check the economic calendar. That's really good. It's very important that you understand what's going on economically and, look at different countries, look at what's happening. Is the economy strong? Is it weak? How does this affect the domestic currency? And how does this correlate, or what are the relations with other countries and other domestic currencies as well? If you've got questions, now is your time to ask me questions. Let me go back and share the trading screen. Because someone is asking about RSI, right? So if you look at the, just going to extend this. So if you look at the RSI, you'd see that I have some levels on to the right side. We have 90, 80, all the way down to 20, right? And you can see that the primary levels are 30 and 70. And what this basically means is if the market is trading above this level, 70, it means that it's overbought, right? And what happens when the market is overbought? It tends to push back down. If it's trading below 30, which is a primary level on the RSI right now. It's also anticipated that the market would push back up because it's oversold right now. It's trading below level 30. Now I also have level 80 here and level 20, which is like my peak point. So if it's trading above level 80, I just know that it's really overbought and there could be potential pullback to the downside. The same thing for the oversold levels, right? If you're seeing the market trading below 20, which is like the peak or the lowest point, or not the lowest, but my lowest, it could get down to 10, sometimes even 9. There are times where gold has crashed all the way down to 9 on the RSI. So that's just the indication, right, for the basic or the primary indications for oversold and overbought levels with RSI. Now, what I was trying to tell you is that you don't just trade the RSI because it's oversold and you want to, sell, or it's overbought and you want to sell. Let me give you an example, right? This happened with gold. You can see that the market right here, if you look up here, you can see whatever you see on your chart here with the candlestick is interpreted here in the RSI. So what this means is this candlestick was overbought, right? You can see it up here. Now, if you sold because, well, it's overbought, I just want to sell and make some profits, what happens? Consolidation to the top side, right? If you still sold again, it's still overbought, it's at 82, I want to sell and make profit, what happens? Consolidation, upside. If you still chose to sell again at 84.5, what happens? Pullback, upside. So you can see that all this while, let me see if I can indicate that here. Okay, I can. All this while that the market was overbought, it trended to the top side. So this is why you should not just trade RSI in isolation. Okay, you don't trade the RSI in isolation. You want to see probably a divergence. You want to see, the markets react to areas of support and resistance. You want to combine with technical analysis and, trade with multiple confluences. So the person that asked about RSI, I believe that this was able to, enlighten you even more about how to use the relative strength index. All right. But currently with gold, guys, we have new resistance created here, right? Gold is still bullish at the moment. I expect a pullback. I expect it to drop down even more than this. But for now, we're still bullish. And what we're going to be looking for is buy opportunities until the market bends. So if we break above this point, we're still going to trade a little more above this resistance level before a pullback, right? I'll be more comfortable to trade the pullback of this market. What do I mean by that? So if we break above this resistance right here, right, and I want to buy, I'm not going to be buying at the break. I would rather wait for the retest, see how the market reacts at that retest. If it gives me buy momentum candlesticks, then I continue to go to the top side. Okay, I'll be more comfortable to trade at the key level, see how the market acts at the key level, and I react to it, than to just hop on the trade immediately after the breakout. If you always trade like that, you could fall victim into fake outs where the market just push back up and fall back in, just like here, push back up, fall back in. So that's what you want to look out for on gold. That's what I'm looking out for on gold at the moment. All right, guys, we're going to go ahead and take a break right now, taking some of your questions. And when I get back after this break, I'll be coming back with Tunmise and Happiness and take all your questions as well. I would also have basically just, summarize the session and interact with you guys. And remember, I told you guys that I was going to give you an advice, and this applies to, I'll just give you one advice, a very important one. This applies to all level traders, right? Regardless of your level of trading experience. You need to see trading as a marathon and not a sprint. Okay, it's something that you want to build a business on. It's something that you want to develop a long-term mindset on. Once you do that, first, it will create this calmness in your body.
calmness in your mind, your emotions, which is one of the important things with trading. It's the mind. I saw someone ask me a question about, I think something about strategy and the best time to use a strategy, or I think it was about, let me see. Yeah, the win rate. This was from Michael. The win rate with the weak field strategy, I believe, for intraday traders, right? And my answer to your question is there are a lot of strategies. Okay, a lot of strategies. Some of the strategies work. Some, in fact, all strategies work. It just depends on who use it. It depends on when you use it and how you use it. Okay, and all this also comes down to your mindset, your psychology. The RSI overbought and oversold strategy works, but when do you use it? How do you use it? Who uses it? Okay, and by who uses it, we're talking about what's the experience that you've had using the RSI strategy. I can use the RSI properly and smoothly because I have an experience in it with the divergence and all that. But somebody that's just coming to the market today and he learned about overbought and oversold may have difficulties on the first day. So treat trading like a marathon and not a sprint. Develop a business mindset. And by business, when you're getting into a business, you're looking at long-term perspective. That's how you want to see the market. That's how you want to see the market. You don't want to come into the market and think that a $6.6 trillion global market, I can make $1 trillion in a day. Come on. So develop that mindset and also understand your strategy properly. Any strategy can work, but how do you use it and when do you use it? That's the important thing for you. And that's it, guys. Right about now, I'll be going, we'll be taking a break. And again, when we get back, I'll be coming back with Tunmise and Happiness, and we'll be concluding and rounding up the session. I believe you guys learned something today. In the meantime, you can go ahead and let me know in the chat what you learned. And I'll see you guys in a few minutes. All right, everyone. Let me know in the chat, guys, if you can hear me. Guys, let me know in the chat if you guys can hear me. It's the Q&A session with three of us, myself, Tunmise, and Happiness. And I believe you guys have amazing questions for us from, the sessions that we've all had, the beautiful sessions we've all had. So this is the time where you get to ask us your questions. You can go ahead and ask your questions in the comments. And if you like, you can choose who you are directing your questions to. Otherwise, we'll just go ahead and answer your questions, randomly. Okay. I think we have one from Two Best Video, and he's saying, my question is, how can I analyze 1 minute, 5 minutes, 15 minutes, 30 minutes to 1 hour? Because all your teachings are based on daily, weekly, and monthly charts. I need more clarity. So what you need to understand about time frames is that, first, there are multiple time frames in the market, right? Just like you said, daily, monthly, weekly, all that. And these time frames work for, so for example, the daily time frame would obviously take longer because each candlestick is a daily candlestick, right? So it's going to take longer for your financial results to be determined. The 5 minutes time frame, the 1 minute time frame, the 15 minutes are for intraday traders. So the first thing I believe you should ask yourself would be, what kind of trader am I? Am I a day trader? Am I a swing trader? Now, if you're looking to trade only during lower time frames and close your trades during the day, that means that you're looking to execute your trades at 5 minutes time frame, 15 minutes time frame. Okay, so it all comes down to what kind of trader you are. Another quick hint I can give you is that regardless of your trading style, it's important to pay attention to the higher time frames because they give you an overall view on market structure. And then you can be aware of what's going on a higher scale, and on the lower time frames, you can trade in that direction. And if you want to trade opposites, you're aware that you're trading opposite, and it could be for short term. So that's my answer on your question. Happiness, I see you're smiling. Do you want to answer the question, or you want to take on another question?
Yeah, no, I just someone tagged me, particularly to a patient. That's why I was.
All right, carry on.
Okay, question from one called Barnabas. So when was the moment when I moved from a struggling trader to a profitable trader? I think that was around the ending of 2022. Like I said, that was when I started seeing reasonable profit from the market. Although I started trading 2020, so it was a whole lot during that period. But I started seeing good profit from the market around 2022 ending.
Okay. The person that asked, you have your answer. But I think that it's dynamic for different traders. I know some traders that spend less time to become profitable. I know some traders that spend more time to become profitable. And what really matters is your consistency, the work you put in, your determination. I don't know how long. You said 2022 ending, right? Happiness. Yeah, it could take you, the person asking, it could take you 6 months, it could take you 5 months, it could take you 3 months, it could take you a year. It's just dynamic, okay? It all comes down to how much work do you want to put in to this craft or to this business. Tunmise, you're gonna have to answer a question, you know. Are you ready?
Yes.
Okay. Okay, let me read one for. Okay, this one says question for all, right? But Tunmise, you can start answering the question. He says, this is David Eden. He says, if you were to start again as a beginner trader, what would you do? What would you do, you know, differently? And maybe not differently, but what would you do generally? That's his question. I don't want to bend his question. So what would you do? And who would you reach out to? Where would you get your knowledge? This is like a 3-in-1 question. What would you do if you were to start again? Who would you reach out to? And where would you get your knowledge?
Okay, thank you for that, Ambrose. All right, for the person who asks that question, I would start with what would you do? So, of course, I would do what I did, okay? And what I did was I started investing in learning. You know, I read books like, one of these books called Candlestick Bible and then Naked Forex. As well, I would follow platforms like Octa FX who are intentional about teaching, you know, their traders, you know, about how to trade. So that is what I'm going to do. And then who would you reach out to? Of course, you know, when I started out, I tried to see if I could reach out to few persons, but there were not so many profitable traders that much in Nigeria, and we didn't reach. So, but what I'm going to do if I'm going to start as a beginner trader is I would like to be in communities of other trader, okay, where they talk about their failures, their successes, they ask questions. Because when you surround yourself with traders, you'll be motivated, okay? When you are a lone ranger, you can, you can lose motivation and be like, oh, you know, trading is not for me. But the moment you are within communities of like minds, they get to blow up your mind. When you see your colleague being profitable, it fires up your spirit that, okay, you know, your time is coming. All right. And lastly, he says, where would you get your knowledge from? Of course, I've said it, you know, I leverage on books and also leverage on webinars like this. So this is an opportunity for you to hook yourself up with Octa FX as they dish out quality knowledge, you know, on trading. Thank you.
Thank you very much for that answer. It was pretty straightforward. And Happiness, do you want to answer? Do you want to tell us what you would do differently?
Yes, finish it.
Yeah, I said everything. But let me ask you guys, you know, I mean, the audience are supposed to ask, right? And they're asking, we'll get back to them. But I just want to ask, based on this question that this person just asked, would you really want to go back and start again?
Me?
If you had the opportunity to do that, would you?
No. Although, me started like during my beginner days, it was too brutal. But I wouldn't want to go back.
Tunmise, how about you?
I have now. No,
I would really want to go back, you know, because I just have fun, you know, like seeing a chart that is always dynamic. So what you see today might not be what you see tomorrow. So I love an environment that is ever changing, and then you have to just keep thinking, you know. So it's not something that is though say trading is generally boring, okay. However, you still have to think, you know, it's not like as though you see the same pattern every time.
Yeah.
You know, you have to think, you have to make some analysis, you have to do some reading, you have to do some studies and all. So I love that kind of you know, the vibe it gives me. So I would really want to do it again.
Okay. It's good that you guys have different answers. But yeah, whichever one works for you guys. Okay, I'll get back to the chat. I think someone has a question directed to me. Question to Ambrose, this is from 92. How would you handle NFP and how do you check the news? It has caught me off guard before. Share your thoughts. So one of the ways that I usually advise traders to trade the news NFP is to wait for the news to be released, right? That you're more comfortable to trade after the news has been released. If you want to get in and take advantage of volatility, that's fine. But use proper risk management and just know that the market could take you out because it's going to move wildly up and down, which is why I always say wait for the news to be released, wait to see the direction of the market, and you can trade in that direction. The market moves, right? There's always opportunities every day in the market that you can capitalize from. Let's see if you have another one. But if you guys want to add to this NFP question, you can always go ahead and add if you have any answers for this person. So this person is asking, Best is asking, how many lots can I use for $100? And how many orders can I open so as to make my equity not to go to $0 before making profits? Any of you can take the answer to this one.
Okay, so let me take the answer. All right, okay. So the person is asking how many lot size can I use
for $100,
and how many orders can I open in order to make my equity not to go to zero, all right, before making profit. So I would only tell you what you can do, okay, to make your equity go to zero. So I think from there you get a clue of what you should not do or what you can do to make your equity not to go to zero. So what you can do to blow up your account is, number one, weighing on heavy lot size. All right, so you are trading a $100 account and you are using 0.1 lot size, you are ready to blow up that account. All right, or you are trading a $100 account and you use heavy lot size in a volatile news environment, then you are ready to blow up the market, right? So in Forex, okay, capital is very important, except you want to gamble your way, okay, which, gambling now, there are higher chances and probability that you would not win. And of course, you can be lucky, all right, and your $100 becomes $1,000 or $5,000 or whatsoever. Okay, so but if you don't want to blow up that account, then use a minimum lot size. I can only tell you this, and it's very simple. Okay, if you need more money to make more money. However, I started from $100. Okay, so my lot size was just within 0.01 to 0.02. All right, and 0.02 only happens when I have more like a higher conviction on that particular trade. Okay, you just know that the market does not respect your feelings, does not respect your capital. All right, so you have to play along, with a lot size whereby, a lot size that can cushion the market when the market comes back against you. So you don't want, when the market takes 2 pips backward, your $100 is gone. All right. Yeah. So you want to make it one step at a time. So that's what I'm going to say.
Okay, very, very precise answer. Okay. Yeah, Happiness, go on.
I wanted to add to it. Now, when it comes to $100 account, for me, I see, $100, it's more like a flipping account, but it all depends on your risk tolerance as a trader. If you are willing to risk it all. Then if you want to be conservative with your trading, fine. Then the percent you can put in, or you can decide to risk, let's say 50% of the account, 2%, 3%, but I don't even know 2% of $100. It's very small. That's why I'm calling it a flipping, account. Yeah. So for you to make reasonable profit with $100, you should be risking at least 50% of the account, or let's say 20% of the account. Well, it all depends on your risk tolerance. Same thing is applicable to higher capital. Just know what you're willing to risk, and that will determine the lot size you use.
Perfect. Tunmise, I'm seeing you smile. Do you have something you want to tell us?
No, yeah, like she has played it very well. It's a flipping account. You get, so $100 is not an account whereby you want to wake up tomorrow and buy a Lamborghini. So yeah, there are higher chances that you won't survive. Okay, and there are also chances that you will survive, but the chances that you will survive is very slim. So
Okay, guys. So I think just to summarize from the points that they've all made, I think it's important that you're aware of the risk on your accounts. You know, how much do you want to risk on your account? It's very important to understand your risk tolerance before you start trading. And if you're going to be using smaller account sizes, you're using that to build confidence so that as time goes on, you can increase your balance, your equity, you know, increase that, trade more, and potentially make more profit. All right. Sorry, Avida, what did you say?
I said, I guess you've seen the last question in the call.
Yes, I have. So for anyone joining right now, if you're just joining us, this is a Q&A. This is the Q&A section of the How to Invest with Octa. And in this section, we want you to ask us all the Forex related questions that you have. I mean, I have really smart people here, really skilled traders that want to answer all your questions. They are hungry for questions and they want to take on your questions, right? You guys are not concurring to what I'm saying. So, guys, type your questions in the chat, and yeah, we'd love to answer your questions. We can only take 2 more questions, and yeah, that'll be it. Someone's asking if there'll be another live session with prices like this again. I enjoyed the live and knowledge gained. Hopefully, and it's amazing to have you on here as well. I believe that everything that you learned today, you would put into practice, and I can't wait to see the results that you get, the beautiful results you get out of the things you've put into practice. Okay. Deborah is asking, what is the 1 lot equivalent to? Does anybody want to answer that?
One lot size.
Yes.
Okay. Yeah, 1 lot size is equivalent to $10. So we could say like that's like 100,000 units.
Units, yeah.
So when you're using 1 lot size, 1 pip is gonna give you $10, right? So if your trade moves, you're using 1 lot size and your trade moves 2 pips, that's $20. If it moves 100 pips, that's $1,000. So yeah, that's what 1 lot size means.
All right, Happiness, do you want to add to that?
That's 1 lot size.
All right. What did you say, Happiness? What did you say? You said that's 1 lot size.
I said there's
Yeah, because you were smiling, so I felt like
I said there's nothing else to add. 1 lot size is equivalent to $10.
Maybe there's yeah, but I was thinking because you're smiling, so maybe there's more to add to a lot size that he did not add. So okay, someone is asking, which is the final question, actually. Someone is asking about lot size calculator, right? So I'm just going to briefly answer that. With Octa, there is the profit calculator that you can take advantage of. It's called, we have the PIP calculator. Let me see if I can go ahead and, show you guys what it looks like. So this is the PIP calculator, right? You can always get this calculator from Analysis and Education. You come down to Trader Tools. You have the trading calculator, the profit calculator, the PIP calculator. You can use it to calculate your lot size, your stop loss, your take profit, how much you're potentially going to make, and how much your risk could be on a particular trade that you want to make. Okay, so I just wanted to brief you guys on that. The person that asked and show you guys what it looks like. You can use the website octaafrica.net to take advantage of this profit calculator. All right, that's the last question. It was really an amazing session with you guys, the How to Invest with Octa. And before we go, I just want to ask Happiness and Tunmise, what do you guys have to add, or what do you guys have to say to our viewers? It could be an advice, it could be just something to tell them to probably improve or boost their trading confidence. Happiness, you can go first here.
Please first, yeah.
Just like you said, it was indeed a nice section, guys. So this is just what I have, to leave you guys with. Trading is not easy, but you can make it easy for yourself once you get to accept the processes that comes with it. You don't need to rush too much into, trying to hack everything or pull out the money from trading. There are processes you need to follow. So as a beginner or a struggling trader, you just need to calm down and get all those processes right. You've seen three of us who've shared our insights about trading and our different strategies. So if there are strategies you want to pick up from this section, pick it up, back test, practice, understand everything the strategy has to offer before you start applying that to your life account. So just one step at a time, don't rush. Get the process and make trading easy for you. Just that simple.
All right, guys. I believe you guys heard Happiness. A very amazing advice for you traders. And over to you, Tunmise. And your advices are usually harsh advices. You say you can blow your account. You can. Let's get it.
I feel a lot of persons want sugar-coated advice, but they won't get it from me. They won't get it from me. All right. So what I'm going to advise you is there is so much pressure in the space. So you go on Twitter, you see somebody say, I made 1 billion today, I made this today, I made that today. All right. Either it is real or not. All right. Don't pressure yourself. Okay. Don't go back to your account and say, yes, I can make it. Or you see someone send a screenshot with 100 lot size, 40 lot size, 5 lot size, and with your $1,000 account that you are managing, you place a 20 lot size. That might be too risky for you, or even for your experience in the market. There are people who are already well experienced in the market who know how to play around their lot size. So no pressure. All right, take it one step at a time, and try to cut off any form of distraction and stick to one mentor, one source. You have Ebuka, you have Happiness, you have myself, you have Octa FX. It's important for you not to eat from different plates, because you will not be healthy. All right, various persons cooking their own food with different spices. However, when you come to a source, you learn. Okay, you learn faster when you are learning from one person, because you would not be confused. All right. But when Ebuka says something, Happiness has said something, and then you go somewhere else, they say another thing, and then you are confused again. It slows down your growth. So limit your distraction, stay focused. All right, stick to your learning process, and you will make it. Your time has come. Thank you.
That was really good. That was really good. Thank you guys for that. Both of you have given the traders advices, and I believe that they're going to listen, and not just listen, but also put it into practice. It was really amazing, the advices you guys gave. And I'm just going to wrap up with this, right? For everyone listening, Forex trading itself sometimes can be an emotional, roller coaster. And it's very important that as traders, you cultivate the right mindset to navigate through the ups and downs. One of the advices, I'm going to give you guys two. One thing you want to do is to focus more on the process, not just the outcome, right? So instead of solely looking at profits and losses, fixating on profits and losses, it's also good that you concentrate on executing your trading plan effectively. Apply proper risk management, be disciplined, apply proper and thorough analysis and consistent decision making instead of just rushing and making rash decisions. And also, you want to stay humble and grateful, right? You need to remember that Forex trading is a privilege, and success is never granted. So you want to stay humble in your approach. You want to learn from both successes and failures, and you want to always remain grateful for the opportunities that the market have presented to you as a trader. And yeah, that's basically my advice, and that's what I have to say to you guys. It's really been an amazing session how to invest with Octa. I believe every one of you learned something today. You can type in the chat what it is you've learned from this session. And I'm about to wrap. So if you guys have anything to say, you can go ahead and say now. Otherwise, we'll just say bye to everyone.
All right. We done, right?
Are you going to say something, Happiness?
No.
Okay, no. Tunmise, do you have something to say to the traders?
Yeah. To
the traders watching.
Oh, yeah. I mean, I will just say goodbye.
All right, everyone. Thank you very much for joining.
Make sure you're trading with Octa to create your trading account and utilize the promo code.
The promo code How to Octa. Beautiful. Thank you very much, Happiness, for remembering that as well. Let's see if I can. Okay. Put up the promo code for everyone to see. How to, with Octa, you can double your deposit to get a 100% bonus to your deposits, and you can utilize this, take advantage of this for more profitable trading, guys. Thank you very much, everyone. Thank you, Happiness and Tunmise. I really enjoyed your sessions as well, and hopefully we'll see them in the next one. Bye, everyone.
Bye, guys.